In today's episode, I'm going to share with you everything that you need to know to begin day trading today. My name is Ross Cameron. I'm a full-time trader, and in this episode, I'm going to share with you 27 years of trading knowledge. I'm going to walk you through the basic concepts of how trading works. I'm going to share with you how to find the strongest stocks to trade on any given day. I'm going to teach you how to analyze those stocks, both from the perspective of fundamental analysis and technical analysis. That means I'm going to teach you how to read candlestick charts, how to analyze the correct places to buy and sell, how to manage your risk, and I'm going to present to you a trading plan with a written step-by-step strategy that you can implement in your own trading starting today. And even better, I'm going to show you how to get started without taking any risk. I'm going to teach you to trade in a simulated environment. That way you can practice the strategy that I'm trading every single day and that you're learning without risking real money. Once you meet the certain metrics for success in the simulator, I'm going to teach you how to transition from simulated trading to real money. I first got interested in the market during the dot-com bubble of the late 1990s. All of my experience in the market culminated with me funding an account with $583.15 and growing it to more than $10 million of verified and independently audited trading profits. Now, I'll be the first to tell you that my results are not typical, but it is my unique experience that puts me in the position to be able to share with you what is actually working in today's market. Because guess what? I show up to trade every single day. And so everything I'm sharing with you, the strategies, the techniques, are being put to the test with real money by me every single day. Now, before we jump into this episode, I want to caution you of one thing. If you don't have the attention to watch just 5 minutes of this episode before you click away and get distracted and do something else, I've got some bad news for you. You probably don't have what it takes to be a successful trader. The reason I say that is because success in trading requires a tremendous amount of dedication, discipline, and drive. But if you really want to learn, if you're ready to learn, I'll tell you what, I'm going to share my strategy with you. So all you have to do is bring the 3 Ds. You bring the dedication, the discipline, and the drive, and we can make some fun stuff happen. So let's go ahead and jump into this class. Now I'm going to go ahead and make this slide deck full screen. We have a lot of topics to cover today. I'm going to be condensing 27 years of trading knowledge into this ultimate guide of how to start day trading. And I want to begin by helping you identify your purpose. Let's jump onto the whiteboard. This is the reason why you want to day trade. Now, I think for a lot of people, they come with this very simple answer that it's about the money. And while I think that that's fine to be motivated by money, I want to take it a step further and help you identify what is it that this money is going to help you achieve. The reason I think it's really important to clearly identify your purpose is because learning to trade can be very difficult. I sometimes say that this is the hardest, easy job in the world. And the reason I say that is because on the one hand, sitting here and punching a couple of keys and then looking at your P&L and being up $3,740.04, as you can see I am this morning in less than 90 minutes, is pretty impressive. That's certainly nothing like swinging a hammer up on a roof in July, right? I mean, this is a very cushy job, but it's also very hard. And the area that it's hard is that, and this is the blessing and the curse of the market, is you can actually spend years struggling to just make $10 a day. And you might think, this is crazy. I'm not trying to drive a Lamborghini. I'm not trying to do anything fancy. I'm just trying to make $10 a day. Why is this so hard? And the reason that it is so hard is because you won't make $10 a day consistently until you have a consistent system and a process or a strategy that you follow every single day. But here's the blessing of the market. Once you have that strategy, why would you stop at $10 a day? Let's say you're making $10 a day trading with 10 shares. You go up to 100 shares, you're making 100 a day. You go up to 1,000, you're making 1,000. You go up to 10,000, you're making 10,000, right? You start to scale your strategy up. And so through this episode, I'm going to share with you how to lay the foundation of a strategy, and I'll share with you the strategy that I think is the most consistent, and this has been in my own experience, and then how you scale that strategy up once you begin to find some early signs of success. But we have to talk about the real purpose here, because for me, what I found when I got started was that what motivated me actually was not the money. And I've known a lot of people who came into the market focused just on how much money they can make, and they end up spiraling and they blow up their account and they're gone because they're focused just on the money. What I want to encourage you to focus on is not the money, but the process. What I consider the money to be is a byproduct of a successful process. And this has step 1, stock selection criteria, step 2, risk management. You've got rules for technical analysis. And when you follow this process to the T every single day, then profits are the byproduct. So what's going to motivate you to go through this learning curve to get to the point where hopefully you're able to produce consistency? So for me, it wasn't the money that was the motivator. For me, it was freedom. And the reason I say that is because when I got started, I had graduated college just after it was the Great Recession. So 2008, 2009, we had this Great Recession, and then we had this sort of market recovery, and I graduated into an economy where the job market was dismal. There was nothing. You couldn't find a job, even if you had a master's degree. It was very hard to find work. And I realized very early on that I couldn't depend on anyone else. In fact, my mom worked at a hospital for over 40 years before being unceremoniously laid off. They let her go. And to me, that was really sad that someone could have that much tenure and that much loyalty to one place, and they don't have loyalty to you. So you have to put yourself first. And having seen that, and that happened right when I was finishing college, seeing that firsthand just gave me it just gave me such a terrible feeling about entering the job market. What's the point? There's a quote by Jim Carrey. He says that one of the things his father taught him is that you can work very, very hard doing something you don't like and still fail. So you might as well try to do something you really love. That's not word for word, but it's something like that. And that really resonated with me. So for me, when I came into the job market, I was at a point in my life where my father had just passed away. I was a young adult. I was kind of on my own, trying to figure out what I was going to do. I had a college degree that felt more or less useless. And I wanted to find a way that I could cover my cost of living so I could spend time figuring out what I really wanted to do with my life. That was my goal. And I wanted to find a job where I could make that kind of money without having to work 8, 10 hours a day, because then that would take up all of my time and I wouldn't be able to spend time exploring the things I might really like to be doing with my life. And so I had a friend that had made money trading penny stocks in high school. He made $16,000 on a penny stock. And as a young man would, who's in high school, he bought a used Nissan Pathfinder. He bought a big screen TV in his basement. And he even had one of those arcade machines, like an old arcade machine that they used to have at Pizza Hut. And it was amazing. But that inspired me. When I got out of college, I thought, if Ben could do it, maybe, just maybe, I could do it too. And so I came into the market with this goal of just trying to find maybe 1 or 2 opportunities a year, thinking that would be enough to maybe make $30,000, $50,000 just to keep my head above water while I figure out what I really want to do. So for me, my motivator for learning how to trade was freedom, the potential to be my own boss, essentially to be self-employed. But the problem with a lot of times where you're self-employed is that your clients become your boss. If you're self-employed as a contractor, a general contractor, or subcontractor, something like that, you still sort of have a boss. I mean, you're your own boss, but only sort of. So freedom, the ability to be my own boss, and something that I really admired in trading was time. That I could have more time in my life. Because what I knew was that most active traders were really only trading for a few hours each day. And then the rest of the day, they had all this time to do other things that they might like to do, or even have second or third sources of income that they're generating from that time. So for me, trading wasn't something that I was planning on doing for 8 hours a day or 40 hours a week. It was something that I thought could also supplement other things that I might start doing. I just wasn't sure what those things were just yet. Now, as we go through the class, one of the things that I'm going to encourage you to do is to actually print out some of the perfect examples of charts to put them around your desk. So it's inspiration. When you see an A quality setup, you'll reference that chart and you'll be like, oh, wait a second, I know that. Right? I printed this out from, Ross's PDF or whatever. So I've got it right here. That's what I'm looking for. Now I'm seeing it in real time. Boom. But what I also encourage you to do is to sort of put that image of the life that you want around your desk. This is the life of self-sufficiency. This is the life of freedom. This is the life of spending more time with my family, because that is what's going to help you stay disciplined in those moments where you need to dig deep, where you need to dig deep because learning to trade is difficult, because you're getting frustrated, because perhaps you've taken a loss. And while it may only be in the simulator, you may feel that moment of disappointment. And I want you to understand that you're not alone in feeling that way. I feel those same feelings. I get really frustrated at times when I have a big loss. I get disappointed. The difference between me and perhaps a beginner trader is that I don't act on those emotions. I've gotten better at having the discipline to recognize that I'm feeling frustrated, I'm feeling emotionally activated, and if I continue to trade in this state of mind, I will not be trading at 100%. And that's why the next topic that we have to cover is on mindset. The mindset of winning. Something that I've noticed in the market, which I think is really unfortunate, is that sometimes it feels that the people who need the money the least are the ones who make the most. And it's the traders who really desperately need money, like I did when I was getting started, who really struggle. And why is that? I think that all ties together to mindset. So success is about, in a lot of ways, a state of mind. Traders who have a lot of money, who come into the market and they already have a lot of money, whether it's because they had another job or they have savings or whatever, it doesn't matter. They come into the market with money. They come in with a certain degree of confidence. They don't need to make money from trading this week or this month to pay their bills, the way someone like you or I might. So they're able to approach trading from this place of genuine curiosity. Like, hey, if this works out and I can make some extra money trading, that's awesome. And if it doesn't work out, that's okay too. And that detachment is an emotional detachment. And it detaches you from that big emotion of anger and disappointment that comes with losing money, or from the feeling of being so elated when you make money. With beginner traders who are really tight on money, the emotional highs and lows can be really big. And here's the problem with that. We jump onto the whiteboard. You have these big highs and lows in your emotions, and what you'll notice is that this will correlate with a very erratic equity curve. So traders who experience this will have profit loss curves where they'll go up and then they'll have a big loss, and then they'll go back up and then they'll go back down. They'll go back up, they'll go back down, they'll go back up, they'll go back down. They'll be maybe a break-even trader. They're not making money. And it's the traders who have more of this sort of narrow band of emotional range who end up being the traders who just have this sort of, I'll do it in a different color so it's easier to read, have this kind of just nice, gradual, slow and steady, ascending equity curve. And I'll actually show you, if we look at my equity curve right now, we can just look at the last 90 days, just as for example, the last 30 days, the last 90 days. You can see how this is the equity curve of a trader who clearly has solid metrics, great profit loss ratio, great accuracy, a strategy that's working. But at the end of the day, these types of metrics here, this creates a tremendous amount of self-confidence. So this creates a trader who is no doubt going to be in the mindset of being a winner. So the winning mindset, it's more than just actually making money. And this is sort of a tricky thing, because if you have to have a winning mindset in order to make money, how can you come to having a winning mindset if you're not yet a winner? How can you, in other words, fake it until you make it? And so I think the question here is, what is it that makes people who have more money just seem like they're able to approach it from this perspective of nonchalant, I'm just going to learn, and whatever I learn is just genuinely great? They've taken the risk off the table of, if they have a big loss, that means ... right? If I have a big loss, that means I won't be able to pay my mortgage this month, or I won't be able to pay my car payment this month. When you start stacking up all of these pressures related directly to your performance trading, you get essentially performance anxiety. And this is one of the things that people don't always anticipate with trading. This is a performance career. It's not a sport, but performance sport, just like a performance sport. It's a performance career where if you perform really well, you can have a great year. If you perform really badly, you can have a bad year. And the truth is, I've had years where I've done twice or 3 times as much profit as I did in the previous year. And then I've had years where I made half as much. So I've found that trading can be a bit more volatile with the ups and the downs. And a lot of beginners are not prepared for that. This is a performance-based sport. So as the better you are at identifying those strong setups, at doing your technical analysis, at choosing the right places to buy, at adhering to your exit indicators, naturally the better you'll perform. But what happens to a lot of traders is that they become emotionally compromised. The pressure to perform starts to get them to the point where, and I speak from my own experience, it gets me to the point where all of a sudden I'm like, I need to hit this number this month. And so in order to take the number of trades required to make that amount of money, if I'm not seeing high quality trades, you know what I end up doing? I reduce my quality threshold. So let's jump back onto the whiteboard here. Let's just say that we have a month where the market's a little bit slower. And so A quality setups, let's say at the rate of typically 10 A quality setups per day. So in a hot market, maybe we have 15 to 25. In a medium market, we have, let's just say 10 to 15. And in a cold market, let's say we have, 0 to 10. So we might have some days where we have almost no setups. And so if I'm at a point where I'm thinking, okay, this is where I'm at on the month, and this is where I want to get to right here, based on me averaging $1,000 of profit per trade, and with accuracy of about 70%, so I'll have, out of every 10 trades, I'll have 3 losers, but 7 winners. Then in order for me to get here, I'm just statistically going to need at least, let's say, 100 trades this month. All right, so 100 trades will get me there. I'm not going to get there if I don't take at least 100 trades. But if the market's cold, then A quality setups, if I'm only getting 0 to 10 a day, let's say I'm getting 2 a day, 2 setups a day, well, we only have 20 trading days in the whole month. So that means I'm only going to get 40 trades in the whole month, and I need 100 to get to my goal. So then what do? I start saying, well, I get a little desperate. I say, you know what? Maybe I'll take some B quality setups. And in a hot market, B quality setups, you might have, 40 to 75, right? And in a cold market, it's going to be less. But by reducing my quality threshold, I can now introduce more trades. But let me present to you with this reality. A quality setups for me produce generally about 70% accuracy. I take these setups, I'm right about 70% of the time. I start reducing my quality threshold and trading B quality setups, 60%. I go down to C quality setups, 50%. I go down to lower than that, and I could go down to anywhere from 30 to 50% accuracy, right? So now you get to a point where you're taking more trades, but your accuracy is declining. You're taking more losers. And so instead of seeing this equity curve like this, you've reduced your quality threshold. So now instead, you're seeing something like this, big losses, right? Because you're taking these lower quality setups that invariably result in big losses. And this is such a myth that beginner traders fall into, that they think in order to achieve this goal, I just need to take more trades. And because there aren't A quality setups in this current market, I'm going to reduce my quality threshold. Whereas a more seasoned trader would say, I'm not going to get here this month. That's not going to happen. That's gone. But this is what's going to happen if I reduce my quality threshold to trading B and C quality setups. I don't want to do that either. Instead, I would rather be content with getting only to here, but continuing to maintain these metrics right here of A quality setups. Because if I continue to trade right in here, you know what I'm going to be able to maintain? I'm going to maintain confidence. I'm going to maintain that mindset of a winning trader. In trading, psychology plays a really big role. And we're going to talk about it a little bit more as we continue on with this class today. But one of the things I want to touch on, and I'll put up my whiteboard here again, is that there's this phenomenon that I've noticed among traders, which we call spiraling. So if you spiral, what does that mean? Typically, what this means is the trader finds themselves in a negative feedback loop where they start taking losses and the losses get bigger and bigger and bigger. And it usually begins with one surprise loss. So number one is, big, unexpected loss. And this is part of trading. I'm not going to lie to you and tell you won't have losses, because we will. We all do, and you will as well if you start trading. So you just have a big unexpected loss, and it's unfortunate, but these things happen. But rather than having the emotional state of mind to say, all right, I'm just going to take a break, I'm going to wait, instead, you start revenge trading. You desperately try to make back the loss that you've just incurred. And the reason that so many of us do this is because of the fear of loss. It doesn't really make sense because we've just taken a loss. So the last thing we should do is like double down on the next trade. But in fact, because we've just taken a big loss, we often feel that we need to make back that loss as quickly as possible, right? That kind of erases it. And so then you want to take a trade as quick as possible. And since your emotion is so strong to help you no longer feel like a loser, but to feel like a winner, you're probably willing to reduce your quality threshold and take a B quality or C quality setup. But what that typically results in is number 2, secondary losses. So now you have secondary losses and you begin a sort of stair-stepping down where your equity curve, which at one time may have been looking quite nice, has now taken one big step down and now another big step down. So at this point, this is where the emotion of desperation sets in. So you have one loss and then you reduce your quality standard here. And so what happens, the result is your accuracy goes down. So you go from being a 70% accurate trader to being a 60% accurate trader. And now your number 3, losers, average losers, get bigger. They get bigger because you've introduced more losers in total and you're trading from a point of emotional compromise or emotional hijack. So then number 4, total losses get bigger, right? So total dollar amount negative gets bigger. Number 5, loss of confidence, loss of account size. And if you have a small account, let's say you started at number 1 with a $5,000 account. And by point number 5 here, you're down to a $2,500 account. You've now lost 50% of your account. In order to get back to 5,000, now you've got to grow your account by 100%. And so what you've essentially done is now, even if you were calm, cool, collected, you've made it that much more difficult to grow your account. This is all self-inflicted, this type of spiral. What I want to present to you is an alternative. I want to put you, instead of on the path to spiral, on the path to a positive feedback loop. So a positive feedback loop looks like this. High accuracy trading leads to strong profit to loss ratio, which means your average winners are bigger than your average losers, which leads to confidence, which leads to bigger size, bigger share size, which leads to even higher profits, which leads to even more confidence. And this is where you have accounts that grow like this. They start growing fast because now you're on a positive feedback loop. It's the exact opposite of what occurs during a spiral. This is the mindset of being a winner. So I'm going to be honest. In order to be a really good winner, you might think it just means taking bigger size and being more aggressive. And there's no question that those are parts of it. But being a really good winner requires you to be an amazing loser, to be really good at losing. There's a saying that by being a good loser at trading, that is perhaps the only path to success. You got to be a great loser. And what that means is that you're cutting your losses very quickly. And when you take losses, you don't allow yourself to fall victim to emotional hijack. The challenge here is that that emotional hijack happens so quickly, it creeps up on you. And once you become truly compromised, truly hijacked, it's very hard to have the self-awareness, the presence of mind in that moment that you're starting to spiral. Usually the way you think of it is, oh, I just had one loss, I'm going to take another trade real quick. And then you're like 3 losses in, you're like, I'm just going to take one more trade. And next thing you know, you look back and you're like, I just took 11 losses in a row. What happened? I wasn't even thinking. And the truth in that statement is that you were not thinking. You were not thinking with your analytical mind. You were thinking from a pure state of fight or flight, emotion, because loss can trigger this big emotion. The way I train people to be really good at losing is to practice trading in a simulated environment. You practice in a simulator because when you lose in a simulator, while it hurts your metrics of profitability, it hurts your accuracy, your profit loss ratio, it hurts the timeline of when you'll be able to go live with real money. It doesn't cost you actual dollars in that moment. And so you start to get really good at exiting trades in the simulator based on the exit indicators that I'm going to share with you during this class. You get so good at it, it becomes second nature. It becomes an instinct to sell when you see that exit indicator. Once you achieve the metrics of success in the simulator and you transition to real money, the way we transition is by having you trade with such small size, with real money, that you desensitize yourself to the emotion that comes with loss. So you start with 50 shares. Sometimes it's even smaller, 10 shares, then it's 50, then it's 100, then it's 200, 500, 1,000, 2,000, 4,000, 6,000, 20,000, right? You eventually scale all the way up. But there's no way you could start on day one with 10,000 shares of real money, 20,000 shares. It'd be impossible because the gains and losses, the numbers would be so big, so quickly. It would be impossible that it doesn't trigger an emotional reaction. I'm at a point now where I can trade with 10,000, 20,000, 40, 50,000 shares. And for the most part, I'm cool as a cucumber. I'm not feeling my heart pounding. My palms aren't sweating. I have such a degree of confidence in my strategy, and I've been able to desensitize myself to losing $5,000 in, a few minutes, that I can take that risk. But it takes time to scale up to it. I'll say right now, I'm in a kind of unique position because having been making YouTube content here for over a decade, really over a decade. I created this YouTube channel in 2013. So for over 10 years, I've been uploading videos to YouTube. I've gotten to really see the whole spectrum of different traders commenting on my videos. And of course, at Warrior Trading, I see the whole spectrum of traders who are in our program who are learning how to trade. Now, usually the traders who join a program, who are going through a curriculum, they're usually taking it more seriously than some of the people that are just watching on YouTube and are kind of like, watch a couple episodes, but they don't really sink in. But one of the things that I can tell you is that I've been able to identify that there are two leading causes of failure when it comes to trading. The first is that traders don't have a strategy. And I saw this a lot during, I guess, the COVID pandemic, where we had this incredible bull market. I mean, the market was unbelievable. The pandemic was really an amazing time for a lot of traders in the stock market. Now, it was a difficult time in other aspects of the world, but for the market, it was very strong. Of course, we had Tesla, we had all these large cap companies that were going higher, and then we had the GameStop short squeeze, and it was like these back-to-back incredible opportunities. And so traders who came into that market with a strategy like myself did exceptionally well. And I've got a number of members at Warrior Trading that earned their $1 million badges during that period of time because the market was just so high. Now, I'll say as always, my results aren't typical, and neither are the results of some of those exceptional traders. But one of the things that I noticed is that a lot of people came in during the pandemic and they were kind of throwing darts, at a dartboard, and they were getting lucky. They were just buying a stock and it would go higher and they would make money. And it felt like a lot of people benefited from beginner's luck. They were just at the right place at the right time. And while beginner's luck is wonderful, it's certainly better than not having it at all, I suppose. There's also a curse to having beginner's luck because you get a false sense of confidence. You start to think that, wow, I'm untouchable, right? Everything I trade turns to gold. I'm winning at everything. But that luck runs out. And that did run out for a lot of people in 2022 when the bear market set in with interest rate hikes, and then 2023 and 2024 was the realization for a lot of these traders that they really didn't have a viable strategy. They didn't know what they were doing. So the first group of traders that fail because they don't have a strategy. They don't really have a repeatable process of stock selection, of where to buy, of exit indicators. It's not systemized. So the results they produce are inconsistent. You have to follow a very consistent process if you want to achieve consistent results. And then the second group of traders lose not because they don't have a strategy. They have a strategy, but they lack the discipline to follow the rules of the strategy. And this is one of the most frustrating things. And this is actually something that I struggled with for a long time when I was getting started. I eventually got to a place where I had a strategy that was more or less working, but I was my own worst enemy. Because when I would have a red day, I wasn't able to be a good loser. I would turn a small loss into a snowball. I would spiral. And so this is what my equity curve looked like when I was getting started. I'd have a little bit of progress here, and then one day, boom, I'd give back a month of progress. And then I'd spend another month rebuilding. I'd make a new high, and then sure enough, there it would come again. And then I would get some progress, and then boom, there again. I have a member at Warrior Trading who's earned his $1.5 million badge, and I did an interview with him, and I asked him, I said, Jess, what was your turning point? Can you identify a specific moment where you kind of went from being a struggling trader to being a consistent trader? And he said, I didn't have a turning point. I just slowly started to suck a little bit less. And so what his equity curve looked like was kind of like this, but we'll sort of zoom it out even bigger. So we'd have a little bit of progress and then give it all back. A little bit of progress, give it all back. And then what started to happen is he would make a little more progress before those days where he would give it all back or give a lot back. So what happened were these red days would start to get a little bit more spread out. And he got a little bit better at recognizing those red days and what was happening before he let them get huge like this. So he was able to recognize, okay, this is a red day. I've been here before. I know what's going on. And eventually his red days just got spaced out more and more and more. They still happen. It's not about not having red days, but it's about how can I have this happen? Basically, how can I reduce the frequency as much as possible? And what I want to show you here from my own metrics is a discovery that I made in my trading. And this is going to help you better understand position management. So I went into my trading and I decided to compare winning days and losing days. This is a nice report that you can look at. And so what I noticed was that on my winning days, if you added up all the winning days I've ever had, I've got $16 million of profit with an average daily gain of $10,000 on my winning days. That's all great. And look at my accuracy, 71% on winning days. That means no doubt I'm trading A quality setups, right? For sure, right? This is great. Everything about this looks good. My average winning trade is $1,300. My average losing trade is $1,000. Everything about this looks great. Now let's look at this right here. On my average losing days, I lose $8,000. Fortunately, the loss there is smaller than on my average winner. But this is something really critical. On my losing days, my accuracy is only 50%. And what this tells you is that there is no doubt that on my losing days, I deviate from my strategy. Historically, I've tended to deviate from my strategy and stop trading A quality setups. I start trading lower quality setups. This is a discovery that even after all of my years of trading, 26 and a half years of trading experience, trading knowledge, comes to the point where I look at this report in a way I had never looked at it before. And I looked at this right here, my accuracy. And then I asked myself, how could I identify that today is going to be a losing day as early as possible? So I stopped trading on that day. And I realized that if on every single day I sit down, on any given day, I sit down and I start the day at 0, right? I'm not holding any positions from the previous day, so I start each day at $0. So in a way, my highest risk is on trade number 1. Because on trade number 1, if it goes wrong, I'm going to go into the negative. But if on trade number 1, I immediately have $2,000 of profit, then right away I've got a profit cushion and now I'm in the driver's seat. And so I said, what if I set a new rule for myself? And this is a rule that I now follow that's not designed about making a lot of money. It's about controlling downside risk. I said, what if I trade with a max position of 1/4 of full size? So whatever a full size position would be for you, maybe it's 1,000 shares, then I'm going to trade with a max of 250 shares until I have made 20 cents per share of profit, which in the case here would be $50. And then once I'm up $50, then and only then will I start trading with my full size position. And what this did for me was it helped me on days when the market was genuinely cold and there were not a lot of A quality setups. It helped me avoid going deep into the red, because it's true that on losing days, part of the reason I have lower accuracy is because even the A quality setups aren't working as well. On a hot day, a good green day, they're working at the rate of 70%. But perhaps on a colder day, even an A quality setup accuracy might reduce to 65% or something like that. It's not as bad as 50%. The reason my accuracy dropped down that low was because I started grasping for straws in a state of emotional compromise, trying to find anything that was moving to avoid having to lock up a red day. And so I realized if I trade with small size on those first few trades and I go red, the amount that I'm red will be at the rate of only quarter size position. So I won't be that deep in the red. In fact, I won't be red enough that I become emotionally compromised. And I'll be able to recognize very quickly, wait a second, I just had 3 losses in a row for my first 3 trades. Today's not the day to push it. Let's keep myself at small size until I'm up 20 cents a share. And if that just doesn't happen, then I'm going to stop right here. And I'm not going to allow myself to go further into the red. Since making this discovery, and this was in June of this past year that I made this discovery. We can look, let's look at year to date. So we'll look year to date here. So currently sitting at just under $800,000 of profit year to date with $1 million goal. We look at my calendar here, and since making that discovery in the end of June, it was right in here that I made the discovery. I then went on to have, it was about 45 consecutive green days in a row through all of July, through all of August, and through the first part of September. And then here in September, I've had 2 red days so far out of the whole month. We look at the month of August, total profit, $171,000. We look at the month of July, total profit, $232,000. And each day I started with this approach right here. This is designed to help me be a great loser. That's all it is. It does come at a sacrifice because I won't be able to make quite as much by starting each day with a quarter position. But what I learned is that it helps me reduce the red days and the drawdown, and that is worth more than the gains I might have made with a full-size position on that first or second trade. So now we've talked about finding your purpose. We've talked about the mindset of winning. We've talked about how to be a great loser. Let's talk about how to start trading with no money. I think this is something that a lot of traders face. A lot of traders have an interest in the market and they have no money. For me, when I was learning about the market during the dot-com bubble of the late 1990s, I was still in school. So I didn't have a real money account. In fact, we had a school semester that was dedicated to learning about the stock market. And we partnered up in groups. So my partner was named Cooper. He lived in my town in Vermont. And so he and I had basically a simulated trading account, a pretend account, and we were buying and selling different stocks, and we were updating our ledger. It was all written every single day. And this for me was such a pivotal moment because I got so inspired and so excited by the potential in the stock market. So during that period of time, I had $100. The first job that I ever had was as a newspaper boy in a small town in Vermont. I was delivering a newspaper and I made $5 a week. And no, it was not in 1950. I was working below the minimum wage, earning $5 a week to deliver these newspapers. That's $1 a day, Monday through Friday. Anyways, delivering the newspaper, and I had $100 saved. And so I went to my local stockbroker's office, and it's Vermont, so you don't really have a stockbroker, but you have office of a financial advisor. And I knocked on their door, and I think actually I called them. But anyways, I called them and I said, I'd like to buy $100 of this penny stock that I've heard about. And they told me, well, I'm sorry, son, we charge a commission, $50 to buy, $50 to sell. Come back when you've got more money. And so that was it. There was nothing I could do. I didn't have enough money to actually go into the market. But that didn't stop me from studying. So I kept learning about the market. I learned as much as I could. I was asking people. My mom had like a 401k, investment account. So I was looking at what are the positions that you're holding. I was looking at all of them. I started tracking them. I got really interested in the market. And then when I was in high school, a couple years later, I funded my first account with Ameritrade, and I funded it with $1,000. Now that was, at that point, my life savings. It had grown a little bit. I'd been mowing some lawns and keeping myself busy. So I had now $1,000. I funded that account, and you know what I did? I bought shares of companies that I was familiar with. I bought American American Electric Power. I bought ExxonMobil, Pfizer, Caterpillar, some of these big companies, household names. But the problem was, over the course of 3 months, which was summer break, I was hoping that this account would grow, that I would make more money in the stock market than I would have made mowing lawns. That was not the case because I only had $1,000. So $1,000 invested in the market over the course of three months, the market grew like 3%. I mean, it didn't grow very much at all. So my account was more or less unchanged. And in those days, you had to pay $10 to buy and $10 to sell. So with the fees and the commissions, I had nothing to show for it. So that was my kind of attempt. But once again, I came up with this struggle of, I don't have enough money. But my problem there really wasn't money. The problem was that I didn't know the right type of stocks I should be trading based on the amount of money I had. Now, during that time, I'd been learning about investors like Peter Lynch, who ran the Magellan Fund at Fidelity. I learned about Warren Buffett, Benjamin Graham, some of these big, well-known investors. Some of them have books that you can read, and I read some of them. The problem was, a lot of those books and a lot of the strategies that these big investors use are totally not applicable to someone with $1,000. Someone that has basically no money, investing in a company that might grow 10% or 12% a year, it's going to take way too long to grow your account. So what I ended up discovering was that there's a different place in the market depending on the amount of money you're coming into the market with and your appetite for risk and your aptitude to actively trade the market. And so for those of you that are coming to the table with nothing, you have no money, and maybe you're saying, Ross, I've got $15 in a Robinhood account. What should I do to grow it? What I would tell you right now is that you're not going to be able to likely grow a $15 account in any meaningful way. But what that account is good for is something much more. It's good for proof of concept, because what you could do is you could trade with one share of maybe some stocks, or you could even just use the simulated trading mode, which is the better thing to do. So you flip to the trading simulator, pretend money. You set your account at, let's say, $1,000 or $3,000. You give yourself a little bit of a cushion, and you start practicing the strategies that I'm going to be sharing with you as we continue on this episode. And what you're going to find is that even with a relatively small account, when you're trading the right stocks, you can grow a small account. And so the right way to get started is to prove through proof of concept in a simulated trading account that you're capable of growing it. Now, during this time, you continue doing other things that can earn you money. Whether it's driving Uber or DoorDash or whatever the case is, you do your side hustles, you continue to make money, and you save as much of that as you can. So once you've proven that you have the skill and the strategy that is producing consistent results, then at that point, you're ready to deploy cash behind that strategy. So I really believe that there is a path to learning, even for people that have basically no money. It's not the path that's exactly the same as someone who comes in with a $50,000 or a $500,000 account. But you know what? Let's play devil's advocate for a second. Let's talk about some of the inherent advantages that come with starting with basically nothing. If you start with basically nothing, or you have a very small account, or even just a couple $1,000s, whatever it is, there's an advantage in that you might be overlooking. And the advantage is that if you make a mistake, you're going to hit rock bottom very quickly. But when you hit rock bottom, for a lot of people, that will force them to take a look in the mirror and ask, what am I doing right now that's really working? And what am I doing that's continuing this downward spiral? And so that's the opportunity to stop, to go back to the drawing board and say, wait a second, what do I have to do differently? Now, honestly, even for me, the discovery of this position management strategy was what came just after having a big loss in June. I had a big loss, and that forced me to take a look in the mirror and ask myself, what am I doing right now? What's working and what's not working? And I'm getting frustrated. And so that process by itself became the catalyst for a discovery. I'm in a position where even though the forcing of that moment is not based on the sort of monetary, like I lost that amount of money and I'm now desperate. For me, it's more about performance because I have so many people here on YouTube that are watching over my shoulder every single day, and they're expecting me to perform, that are expecting me to trade my strategy consistently and to follow the rules of my strategy. So when I deviate, for me, it's very embarrassing from this sort of public perspective of there's so many people watching. So that creates a little bit of a different pressure, but it's still enough for me to take a look in the mirror and be like, you're an idiot. What are you doing? You got to make a change. You got to go back to performing really well because there's a lot of people counting on you. There's a lot of people watching you every single day that expect you being at your top of your game, top performance. What's pressuring you to have that realization with a small account can be, wow, I just took a loss and I blew up my account. The account's gone. And so something as a word of caution for traders who are coming into the market with a big account, maybe high 5 figures or 6 figures or even 7 figures, be careful with that because sometimes having an account that big can encourage you to continue to take risks and risks and risks and start to spiral that account. And rock bottom is a long ways away. So I would actually say that I think for every trader, no matter how much money you have, the best way to start is to practice in a simulator. And the best way to transition from the simulator to real money is by transitioning with small size and slowly increasing risk. So in fact, it puts us all on level playing field. No matter how much money you might have, we all start exactly the same way. And it's because I really think that that is the right way to learn. Now, while it's possible to start trading with no money, and I think it's actually advisable to start with a very small account, the next thing I want to talk about is finding a mentor whose strategy you like. Now, obviously you're tuning into this episode and you may find that you like the way I teach and you like the way I trade. And if that's the case, that's wonderful. And I'm happy to continue to teach and for you to continue to learn from me, whether it's on YouTube videos like this or by becoming a member at Warrior Trading. Either way is fine. But you have to find a mentor whose strategy and level of risk relates to where you're at. For me, if I made Warren Buffett my mentor, and of course, you don't have to know someone personally for them to be your mentor, for them to be someone you idolize, and for that strategy to be what you aspire to. But if I tried to be like Warren Buffett, or I tried to be like some of these other big investors, it would be really silly because their risk tolerance is completely different from mine. And their account sizes are completely different from mine. That's most notable. So for them, making 10% on a multi-billion-dollar account is fantastic. Making 10% on a $5,000 account, that's $500. For the whole year, that's not going to pay for your time to spend every single day in front of the computer. So if you're starting with a small account, you need to learn from someone who's also trading in small accounts. So one of the things that I've prided myself in is that I essentially am perpetually keeping myself in small account status, relatively speaking. So when my account grows, I take the money out, I drop it back down. My account grows again, I take the money out, I drop it back down, I start again. And for me, I'm always in this state of just trying to hit these base hits. Percentage gainer, 15, 20% winner, lock it up, lock it up, lock it up. I want to just continually grow my account. Now, right now, I'm in the middle of a small account challenge. I'm using Thinkorswim as my broker. It's a cash-only account. I can only trade one trade per day, and my goal is to grow this account to $25,000 as quickly as I can. And I'm making really great progress. I think I'm probably a week or maybe 2 away from hitting 25 grand. And the strategy that I trade in that account, it's the exact same strategy that I trade when I'm just trading in my regular account, which has 6 figures in it, usually $100,000, $150,000. The only difference is that in the small account challenge, I can only trade once per day. Usually that's the restriction. I can take 1 trade per day using the full balance, and then I have to wait till the next day. Whereas in my big account, I can trade 10 or 15 times, or I can trade as much as I want each day, as long as there's still A quality setups. At the end of the day, you want to find a mentor whose strategy you like and who you feel that you can learn from. For those of you guys that want to learn more about my strategy, I'm actually going to put a link. It's going to be pinned to the top of this, top of the comments in this video right here down below. And I'll also pin it to the top of the description. That link is where you can download a set of PDFs that accompany this class right here. There will be a trading plan that you can download, which I'm going to be sharing with you as we continue on. It'll also include my small account strategy, my stock selection PDF, and the micro pullback strategy PDF. All of these downloads, it's a free bundle of downloads. They're PDFs. You can download them, you can print them out. And what I want you to do is I want you to put them around your desk. So some of these are going to have charts that you can pin up to your monitors or right next to your monitors. Others are step-by-step guides of this is the process of stock selection, where I get in, where I get out, everything else. So the more that you can embrace fully immersing yourself in the strategy that other people are trading right now, I think the better off you'll be. That's my belief. So if that strategy is mine, then I want to encourage you to just get fully immersed and learn as much as you can about the way that I trade. So now that you understand finding a mentor is very important, we're going to talk about stock selection. So when we talk about stock selection, I'm going to break down for you the 5 pillars of stock selection. So this is going to be 5 pillars right here. And this is in the PDF that you guys can download. So when you download it, it could be a supplement to what I'm going to share with you right now. Now, when we're talking about stock selection, one of the things that we're going to talk about is price, percentage change today, relative volume, RV, which I'll explain in a second, news, and float. These are the 5 most important criteria that if a stock doesn't meet the criteria for each of these I'm about to share with you, I will not trade it. Now, there are some additional criteria that we'll talk about over on this side, which are, I would say, bonus criteria. But if a stock doesn't meet it, but it does meet these 5, I'll still probably trade it. The bonus criteria just make that setup, that stock that much better. Now, one of the things that I should mention before we talk about stock selection is that when I was learning to trade, I didn't have the benefit of having a mentor. I was completely self-taught. And that was because I was learning to trade during a time when day trading wasn't really that popular. It was popular during the dot-com bubble of the 1990s. And then after the Great Recession, after the bubble burst in the turn of the century, we didn't have a whole lot of interest in day trading. There was a sort of big decrease. And then it picked back up, and then we had the Great Recession, right? The financial crisis. So all of a sudden, people were not interested in trading. But that was when I came into the market. So I came in during a period where there weren't a lot of people that you could learn from. In fact, one of the best ways to learn in those days was to move to New York City and get a job working at a fund. Now, funny enough, I actually was living in New York City at this time, and I applied to get a job working at a hedge fund because I wanted to get my foot in the door. And you know what they said? Get out of here. There's other people more qualified than you who have a degree in finance who are applying for this unpaid internship. We're going to choose them first. Your qualifications don't line up for an unpaid internship. But look, working at a hedge fund, there were people lining up and I was not first in line. So it's funny because, I've ended up becoming a very successful trader, but I wasn't able to do it through that path. My hope was that I could learn by working with these people, and that just wasn't an option. Today, it's still probably as difficult to get a job at some of these big hedge funds. And to be honest, if you got a job at Citadel or one of these huge funds, you'd probably be sort of pigeonholed into just, crunching numbers as some analyst, and you wouldn't really gain a lot of experience about what it's like to be a trader. You might make good money, but you wouldn't be actively trading. So finding a mentor for me wasn't really an option, which is why I spent years of trial and error just sort of trying to figure out what worked. And one of the things that I discovered through that period of time was that one of the biggest gifts that I had from my early education in the stock market was the importance of tracking all of your trades. So and this was from the very beginning, I tracked all of my trades in a written ledger in the late 1990s. That was the same in 2001, 2002, when I was trading while I was in high school with Ameritrade. And so when I started trading again, just after the Great Recession, I was tracking every single trade. And by tracking my trades and analyzing this data, I've been able to develop to understand essentially where in the market I make the most money. So if I gave you this data, and I'm going to kind of walk you through it, this right here pretty much describes exactly how the type of stocks that I make the most money on. What you can see here is that my profit comes from lower price stocks. This is all from stocks under $20 a share. Right there's the $20 cutoff. So between 2 and 5, between 5 and 10, and between 10 and 20. And this is millions of dollars of profit. Now, the reason I like trading these lower price stocks is because they make big percentage moves. I've seen $2 stocks go from $2 to $8 in one day. So when you have a 400% move, a 500% move, a 6, 7, 800% move, I think the biggest percentage move I've ever seen was about 3,000, maybe 4,000% in one day. So when you see a really big move like that, that's a dream for a small account trader, because if you bought even a small position, but the underlying asset goes up 3x or 4x, you're going to have a huge winner. Now, if you trade $50, $60 stocks, they don't double in one day. They almost never go up 100% in one day. But $3 stocks, $4 stocks, they'll go up 100% in one day. And we see that all the time. In fact, if we look today, let's say, well, this is an interesting day. We can look at our biggest percentage gainers. Today, we've got 75%, 73%, 62%, 38. And the stock that I traded this morning, which was ONCO here, this one went up about 100%. It peaked at about 100% between yesterday and today. So you could see here, we started down here a little under 350, and we squeezed up to just over 650. So that was a really solid move. And you don't see moves like that on higher price stocks. It's very uncommon. I think the reality is most retail traders like you and I, traders with relatively small accounts, we end up gravitating towards low price stocks because we can afford to buy more shares. When you could buy more shares, that 10%, 15%, 20% move in the underlying asset is a bigger profit. So then, number one, for stock selection criteria, we have to say price ideally is under 20. Now, when I'm doing my small account challenges, I will sometimes drop that to under 10. I'll just say, look, it's a small account. I've got $1,000. I can't trade anything that's $20 a share. So I'll drop it down. But for generally speaking, regular trading account, under $20. Now, one of the things that is also worth noting is that I don't typically trade penny stocks, and even stocks under $2 have only made up about 4% of less than 4% of the $13 million of profit. It's only $400,000 here. So one of the things that I learned is that lower price stocks, while you might think that that's even better because you could buy a 10-cent stock and sell it at 20 or 30 cents, like my friend Ben did when I was in high school, what I've actually learned is that penny stocks can be very difficult because when stocks are below $1 a share, they actually trade down to the 1/100th of a penny. And so what that means is if you looked at a stock that's 10 cents, it's not trading 10 cents by 11 cents. And if it goes up 10 cents a share, it'll be at 20 cents. It actually trades typically 10 cents. Well, it looks more like this. So 10.001, for instance, by 10.002. It could actually look like that, trading down to the 1/100th of a penny. So to go from 10 cents to 20 cents is 10 cents. Each one has 1/100th of a penny. So that's actually 1,000 price increments to go from 10 cents to 20 cents. Whereas as soon as the stock trades over $1, they trade with a spread of 1 cent. So to go from $1 to $1.10 really is only 10 cents, and it's only 10 price increments. So typically we find stocks below $1 are slower moving, and then once they break $1, that's when it gets more exciting. The only problem is that there's a lot of traders when a stock is below $1 who will buy 200,000, 300,000, 400,000 share positions. You buy 400,000 shares of a stock down here at 10 cents, 0.01, and you're putting such a small amount of money in, and you know that you're risking. Well, I got in here. The spread is like this. You're only risking a couple $100. So all of a sudden that stock starts to move really fast. It comes up here to $1, $1.10, and you're going to put that sell order on the ask. And so usually we'll end up seeing these massive sell orders on these low price stocks. We'll talk about that a little bit more when we get into reading the tape. But for that reason, I've found that the lower price stocks and the stocks that start below $1 tend to be a little bit tricky. So in general, I would say definitely under 20, and sweet spot for me is going to be between 2 and 20. So over $2, less than 20. That's the sweet spot. All right, now let's talk about price change. This is criteria number 2. Again, all these criteria are also documented in my small account strategy PDF and the stock selection PDF, which you guys can download with the links that are pinned at the top of the comments and in the description. So now let's look at instrument. So based on percentage change, what we're going to do, we're going to scroll this down here, and I'm going to show you that 99% of my profit right here comes from stocks that are up at least 10%. If a stock does not have the potential to go up 10% from my entry, I should not even trade it. And so that means when I'm looking at a chart, I'm pulling up the chart and I'm saying, all right, let's just pull up an example right here of ONCO. So I pull this up right here as it's starting to move higher. And in this area, we got some really nice trades. And I was asking myself, does this have the potential to go up 50 cents or $1 a share, right? From 5 to 550, 550 to 6. This definitely has the potential to go up 50 cents a share. And it clearly did. This is the type of stock that can move quickly. But if we pulled up something like, I don't know, Bank of America. We'll just pull up Bank of America for a second. So Bank of America currently priced at $39 a share. Could this go up 10%? There's not a chance. This wouldn't move 10%. I mean, it would have to have incredible news. It would have to go from here all the way up to here. What's going to drive it to do that? I mean, like I said, amazing, absolutely incredible news, but it's unlikely. It doesn't happen. And you know what? That's okay, because there's stocks in the market like this that are great for investors like Warren Buffett who don't want billion-dollar positions going up or down 10% or more in a single day. But then there's traders like you and I who need to grow small accounts. And we're not going to do it trading Bank of America. We need to trade the stuff that's moving, the stuff that's volatile. So this stock here, CNEY, that goes from 65 cents up to 90 cents, up to $1.25, $1.30, that's more interesting. Now it's a little on the cheaper side of my price range cutoff, but it's still worth trading. Perhaps. I didn't trade it today. I actually still thought it was a little too cheap. But nonetheless, that's the type of rate of change and the type of potential that you want to see. So number 2, we want stocks that are up 10% minimum. Not only they're up 10%, but have the potential to go another 10%. Number 3 is RV. This stands for relative volume. So the amount of volume a stock has is relative. You might say, oh, there's a stock today that has a lot of volume. And I might say, oh, okay, a lot of volume. What does that mean? It's got 1 million shares of volume. And I'd say, well, it's not really a lot of volume. There's a lot of stocks today that probably, well, once again, let's just pull up the scans and take a peek. How many shares of volume does CNEY have? 208 million shares of volume, right? ONCO has 32 million shares of volume. So that's pretty good volume. 1 million shares, that doesn't sound like a lot of volume, but it's all relative to what's normal for that individual stock. So the term relative volume is comparing today's volume relative to what's normal for that stock. And so it's calculated as a ratio. So if the stock normally trades with 100,000 shares of volume and today it has 500,000 shares of volume, it's got a ratio of 5. It's a relative volume of 5. It's 5 times higher than average. If it's got 1 million shares of volume, it's 10 times higher than average. If it's got 10 million shares of volume, it's 100 times higher than average, or whatever the case is. It just continues to go higher. And so if we looked at these stocks, we'll actually see right here on the scanners, we have a measurement, a column called relative volume rate. And this top stock has a relative volume rate of 16. The second one, CNEY, has a relative volume rate of 7. The one that I traded has a relative volume rate of 273. This one has 21. This one here has relative volume rate of 1,510. That means the volume today is so much higher than is average and normal for the stock. In fact, today you could see it's got over 5 million shares of volume, when yesterday it had only 6,000 shares. How does a stock go from having 6,000 shares of volume to 5 million shares of volume? Well, number 4, news. We like to see that these stocks have a catalyst. So a news catalyst is what's driving the momentum. The reason these stocks are going higher isn't for no reason at all. I mean, of course, there are times where stocks go up because of Reddit and social media, or because Warren Buffett takes a stake or something like that. But generally, the big movers, they go up because they have a news catalyst. They have a reason to move higher. And so what we're looking for is that catalyst. Now, some traders say, if I could just be the first one to find breaking news, I could make so much money. And I'm going to say, That's not true, because I tried the same thing. I thought the same thing. I thought if I could just be the first one to get the breaking news, I'd be rich. And what I learned is that if you're the first person to get breaking news, you don't know what to do with it. You don't know if the news is good or bad. And some news sounds good, but the market reacts poorly, which is really confusing. You might have a headline where the company says they've just signed a contract with the Department of Defense for $30 million a year, and the stock plummets. And you're like, how is this possible? This seems like a great headline. But then you find out that a month ago, they said they were in negotiation to sign a contract for $300 million. Ooh, so signed at 30 is a lot less than potential negotiation at 300 million, right? So it's context. So unless you're able to put every news headline in context, you won't be able to really know what to do. And there's no way that you would be able, it's not a reasonable expectation that you could put every headline in context. So this is what I learned. What I realized was that being the first one to get breaking news is not helpful because I don't know what to do with it. Being the first one to see a stock squeezing up right now that's something I can work with. And so that's how I came to develop these scanners right here. This software that you're looking at, I actually have a development team that's been working for me since 2017, building out this software, and it's called Day Trade Dash, and we designed it to be the ultimate dashboard for active traders. So we've got thousands of traders who are using this software every single day, and they're scanning the market using these stock scanners. So what happens is the second a stock starts popping up, it sends an audio alert and this visual alert right here, and it tells you all about the stock. So this is the stock, this is the time, this is the ticker, this is the price, this is the amount of volume it has, this is the float, which we'll talk about in a second. That's the relative volume, so it's only 2.5, which is good, but not phenomenal. It's up 30% on the day. So all of a sudden I say, all right, let me take a look at this stock. Now, in full disclosure, it's 2 p.m. on a Friday. So this is a great time to be teaching a class. It's not a great time to be trading because most companies don't put out great news on Friday afternoon, only for it to get forgotten and, be buried by Monday morning. Most companies put out great news early in the week, Monday, Tuesday, Wednesday, and then it slows down towards the end of the week. So this, as I check the news headline right here, does not have a clear catalyst. So why did it spike up right here? Well, it's got light volume. It could have just been that some trader out there decided to buy a position or some short seller decided to sell a position, and that was enough to pop it up a little bit, but probably not enough to sustain the move because there's no real catalyst or reason for it to be pushing significantly higher. So in this case, it's fairly easy to do quick due diligence and say, yeah, I looked at it. Nah, I don't think it's going to work. So when we're talking about stock selection, once we understand our 5 criteria, the next step is performing this fundamental analysis right here, which we're going to get into in just a moment. But first, let's look at number 5. Number 5 is the float. The float is the number of shares available to trade, and I prefer trading stocks with a float of under 20 million shares, but lower is better. 1 million share float, no problem. 2 million share float, that's fine. 10 million, good. 15, 18, 19 million, getting a little high. Above 20, probably not going to be as interesting. Now, GameStop in 2021 had a 36 million share float. So it was a little higher, but that was fine. And there are exceptions, but generally under 20 million on a day-to-day basis is going to work better. And if we look at the stock that I traded today, ONCO, the float on ONCO, it's actually 23 million shares. So it's just a little bit higher, but it's right at the cusp. And so in this case, it had some good momentum and it really was, it was pretty clean this morning. Didn't end up holding up for the rest of the day, but it was clean yesterday and it was clean this morning as well. Okay, so the float's the number of shares available to trade. I prefer to see a float of under 20 million shares. And when it comes to relative volume, by the way, I like to see a minimum ratio of 5. So now what I can do is I can take these 5 criteria right here. I can program them into this stock scanner and let this scanner search the market for all of the stocks that meet these 5 criteria and then tell me the second a stock that meets these criteria starts popping up. The second a stock that meets that setup is up 5% or 10%. Now, one of the things that I'll do is I will set the filters a little looser to cast a wider net. The reason I want to cast a wider net is because I want to see what's moving. I'd like to catch kind of all the fish and throw some back and say, nah, I don't like that, I don't like that. Than to just be sitting there with nothing in my filter at all, wondering, is the filter broken or is the market just really slow? Is there something else happening somewhere? I can't really tell. So it's helpful to cast a slightly wider net and then manually filter from there. There are some traders that have said, well, geez, Ross, why don't you just take this and, add a few more criteria and try to just create an algorithm that just trades this for you. And what I have found is that while it's true that there are quantitative trading firms that just trade based on high frequency trading algorithms, they are employing some of the smartest people in the world to try to crack the code to basically print money from the stock market without having to do any work. You just press the button, print money, at the end of the day, you're done. And it's a lot easier said than done to achieve that type of consistency. In fact, a lot of them end up hiring successful traders who are able to help sort of coach them on how to make it work correctly, to the point that you kind of might as well be trading. I don't have the ability as one person I can't compete against those hedge funds with trying to create that type of algorithm. And generally, those types of firms, because they're blindly buying and selling based on the algorithm, they're not going to trade the type of stocks that can go up or down 50% in one day. It's just too much risk. But when you're trading on a small account, this is exactly what I think you want to be trading. So I trade a strategy that has to be executed manually, but I think is perfect for small accounts and for small account traders who, like me, wouldn't be able to employ some, MIT graduate to create some algorithm for trading the market. Now, one thing that I said, we're going to get into fundamental analysis, but I wanted to touch on a couple of bonus criteria here. So these are some of the bonus criteria for stock selection. So number one, a recent IPO. Recent IPOs, recent reverse split. A reverse split has the effect of reducing the number of shares available to trade. What happens is these companies IPO. So first, we'll start with the IPO. So recent IPOs can be strong because a company begins trading on day one, sometimes moves up a little bit, and then usually moves down. And then what often happens is you get this squeeze through new highs, and you go to all-time highs. And this has been true of almost every big IPO. You look at big IPOs like Facebook, Alibaba, Airbnb. They have their initial pop, they pull back, and then they have this rip back up. So I like trading. If I see a stock that meets all of these criteria and I check and I see it's a recent IPO, I'm going to be like, ooh, bonus. That's even better. If I see it's a recent reverse split, a reverse split occurs when a company IPOs, they go down, they go up, and then they start just selling off. They go lower and lower and lower. They get down to like 10 cents a share. It's really bad. And in order to maintain compliance with the exchange, they actually can't be below $1 a share. You can't be a NASDAQ listed company and stay below $1 a share. They'll delist you to the OTC market, which is where most of the penny stocks are. So what they'll do is they'll do a reverse stock split right here of 10 to 1. Or let's say they do 20 to 1. So they do 20 to 1. The next day, the stocks will be at $2 a share. Oops, $2 a share. And the number of shares available to trade when they IPO'd, let's say they sold 10 million shares. They sold 10 million shares on the IPO. So if you owned all 10 million and it drops down to 10 cents a share, you're sad. The next day it goes to $2 and you're like, amazing. And then you realize, wait a second, where'd my 10 million shares go? It says I only own 500,000 shares, right? The number of shares divided by the ratio. So the price goes up, the shares go down. And so what this means is now this company has a float of 500,000 shares, which means every time a company does a reverse split, the float drops down, which means it could go from 20 million to a million. And all of a sudden now the stock fits within our stock selection criteria specifically because of the recent reverse split. So it's a stock we wouldn't have typically traded had they not done the split, but it's just now come into our range of having potential. Number three, all-time highs. When a stock is at all-time highs, we call it blue sky. There's nothing above it, no resistance above it. That can be a particularly strong setup for continuation and strong upward momentum. So recent IPOs, recent reverse split, all-time highs. These are three important ones. Yesterday, volume, less than 100,000 shares. The interesting thing here is if yesterday's volume was less than 100,000 shares, then when today has big volume, like 1 million shares, you're immediately going to have super high relative volume. And higher relative volume usually leads to bigger percentage moves. So these are 4 bonus criteria. There are some others, but this is a good starting point. All right, so let's go back into the screen share here. I'm going to pull up my slide deck, and we're going to talk now about fundamental analysis. So my workflow each day, step 1 for my strategy is to find a stock that's moving. I do that easily by pulling up my scanners and looking at each one of the stocks that's on the scanners and asking myself how closely it meets my 5 criteria of stock selection and or some of the bonus criteria. Generally, each day, my biggest winners come from the top 3 to 4 percentage gainers in the market. So I already know, just because these are the top 5, that I'm most likely to find success trading one of these. So now I just have to figure out which one I like the most. This one has a 71 million share float. It's a little too high. These ones are a little cheaper. So ONCO is sort of the logical choice here earlier, especially when it was up more like 90%. Because at that point, it was in the number 1 leading percentage gainer spot. So we have a stock, let's say like ONCO, that pops up on our scanners. And then I'm trying to figure out, okay, why is it that this stock is moving higher, right? What's the catalyst? So I know it's important that we have a fundamental catalyst, and this gets into doing some due diligence. So I pull up the stock, ONCO, and this is where we have our news window right here. So this news window is telling us basically what that news headline is. So I can see right here, this was yesterday at 4:06 p.m., they had this headline that came out. So this headline comes out, we'll scroll down, and it looks like this is an acquisition. So this filing, a Schedule 13D, is an acquisition, which means this company has reported a acquisition of 2.69 million shares, which is it's a significant number of shares to purchase on a stock that has a relatively small number of shares available to trade. So when we see something like that, that tells us, all right, there's something that this company likes about this stock, right? It's a vote of confidence, a big vote of confidence. Now, if this was a well-known activist investor like Warren Buffett or something like that, then people would probably treat it with even more weight. Because it's sort of a little-known investor from Switzerland, maybe take it with a little bit of a grain of salt, but nonetheless, that was enough for that news headline right there at 4 p.m. resulted in this immediately spiking up. So we immediately went from $3 up to $4.45. And you just have to recognize that this firm has just taken a huge position in the company. And so clearly we sort of have to think, what do they know that regular traders don't know? What do they know that makes them think this is such a good value at this price? And we can only speculate, but we have to assume they know something. And so for that reason alone, other traders say, well, if they seem to know something, they must know a lot more than I do. So I'm going to go ahead and jump right into it. And next thing you know, the stock starts squeezing up. So there's a couple of different filings that I will pay attention to. If we go over to this website called BAM SEC, we can actually pull up a stock like ONCO, and we can look at all of the different filings. So when we're doing fundamental analysis, typically I keep my fundamental analysis fairly limited. So fundamental analysis. The reason I keep my fundamental analysis limited is because as an active day trader, fundamentals matter in the long run, but in the short run, what drives the momentum typically is emotion. The sentiment. People get super excited. They think this stock has a potential to make this massive move, and they buy, and they just think it's going to go higher and higher and higher. So people just get so excited. So during those periods of time when people are really exuberant, the price can become very disconnected from what some analysts might argue is the true value of the company. This was true with GameStop. There was a time in 2020 when GameStop was generating $5 billion of revenue, but the entire company was only valued at $250 million. You could have bought the entire company for $250 million. And it's a company that's doing $5 billion a year in revenue. Now, the problem is, while it was doing $5 billion a year in revenue, it was actually losing money. So the fact that it was losing money was, of course, what gave it its relatively poor valuation. But nonetheless, some were arguing that it was worth, based on book value alone, based on the value of the assets they held, more than $250 million. And in fact, they were right. So the way we can learn a little bit more about the financial condition of a company is through the art of fundamental analysis. And that means actually reading through some of these corporate filings that these companies make. As part of the regulatory requirements to be listed on the NASDAQ or the New York Stock Exchange, these companies have to report quarterly financial results. So they're being very transparent about displaying their balance sheet, their profit loss, and you can choose to read all of these in the statements. So the statements that we look at are 10Q, 10Q, 10K. The Q is for the quarterly, the K is for the annual. We do look at 13G filings, 13D filings. We look at Form 4 filings. And let's see, I guess those are probably, and then we also look at shelf registrations, S1 and S3 filings. So those are the ones that we look at most commonly. So in the case of ONCO right here, we had the filing that came out, let's see, it was, what was it? The 13D form. This was for the large stake that someone had taken, the 13D filing. And then here we could see our 10Q. So this is our latest quarterly earnings statement. And what I typically do, when I'm first pulling up a stock, I don't go into the filings at all. I first pull up a stock, ONCO, and when I was first trading it this morning, I'm trading it in this area. I'm not looking up the filings. I'm not pulling them up. I'm going to show you how to do it because I think it's useful to know that information, but I actually don't do it for most trades when I'm first trading a stock. When I get to the point of pulling up the 10Q, looking at the quarterly filings, I'm doing that because I'm starting to wonder, is this stock going to continue to move higher today? It's already up 50%. Is it going to go 100, 200, 300%? Or is this a stock that has a risk of crashing? And that's a question I have to ask once a stock gets really inflated and starts moving higher and higher in value. If it gets to a certain point, it's just like, how much higher can this go before it rolls over? And so when I look at the quarterly filings, you can read a lot about the companies in these filings, but one of the things that I look at is their consolidated balance sheet. So the consolidated balance sheet, right here, is going to tell us how much cash they have on file. Basically, what is the amount of cash they have on hand. So I look at cash, which in this case is $930,000. And then you can look at their total current assets, including prepaid expenses, accounts receivable, which is $100,000, and then prepaid expenses is $773,000, and inventory $160,000. So you've got about $2 million of assets right here. And they do have some other assets in this area, some prepaid expenses, long-term property and equipment. They're not going to be able to sell these in order to, cover cash flow. Goodwill and intangible assets. These are big numbers that are often on a balance sheet, but that can't really be easily converted into cash. That's sort of the goodwill, the brand name. I'm not familiar with this brand, so I'm not sure if that is really fair to say it's $36 million of goodwill. But anyways, we can then look at the liabilities, which is any loans that they have, the debts, obligations that they have. And of course, the assets and then the liabilities match out. And then we look down at their revenue. And the reason I look at their revenue is I ask myself, how much money is this company making? Is it making a lot of money? Do they have a good net profit? And in fact, they have a net loss of $14.3 million for the 3 months that ended, June 30th, 2024. For the 3 months that ended June 30th, 2023, they lost $6.8 million. And then this is for the 6-month period that ended, they lost $25 million. This is a lot of money to be losing. What in the world is going on here? So what I can tell you is that when I see that, usually what I end up concluding is that, all right, this is, we can read the statements here. We're going to talk about some risk factors So these forward-looking statements include but are not limited to statements. Let's see, where do we have? So one of the things here with this, formerly known as Blue Water Biotech, it's a commercial stage biotech company focused on research, development, and commercialization of innovative solutions for men's health and oncology. All right. Historically, the company's focus was research and development. The problem with companies that are primarily doing research and development is that they do not produce profit unless they have a drug that ends up becoming very successful. And so during the research and development phase, investors are essentially financing the company continuing to research by purchasing their stock and hoping that this company eventually comes out with something that's fantastic and is able to use that to sell to a big pharmaceutical company. And then all of a sudden the company has a real chance at long-term profitability. But unless they can license out some treatment or some drug or sell it, they really don't stand really any chance long-term. So this is very common. So the result here is that we have a company that is spending a lot of money and only has $2 million on the balance sheet in cash and current assets. So what that means is that this is a company that is probably going to need to raise money. How would a small company like this raise money? They would raise money by selling more shares. And this is a form of dilution. If you've followed GameStop at all, something that you might know is that GameStop as a company has been selling a lot of shares. They've actually sold nearly $5 billion worth of shares. It's kind of like an ability to just print money. You say, hey, you want to buy 1 million shares for $5? That's $5 million bucks. You want to buy 1 million? It's another $5 million bucks. Boom, 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 boom. They raise $50 million. And that's what a lot of these small companies do. Now, GameStop has done it on really almost unprecedented scale. They've sold $5 billion worth of stock, and that's given them a huge cash supply. Now, they can now use that cash supply to do a lot of different things. They could start becoming sort of the Berkshire Hathaway where they start investing in different companies. And there could be a point where GameStop makes more money on that $5 billion. Well, it's actually already happening because they're operating at a loss for their regular operations, but the $5 billion is generating interest. So they're already making more money. In fact, they would be a more profitable company right now if they shut down everything they're currently doing and just earn the interest on their cash, which is kind of crazy. But with a smaller company like this, they're not going to be able to sell $5 billion worth of stock. There's not enough people that would buy it, but they could sell a couple $1 million worth of stock. Now, in order for a company to sell stock on the open market, they have to have filed what's called a shelf registration through either the initial prospectus or through the secondary offering, which puts all shareholders on notice that this is a company that intends to raise capital. So we have a shelf registration here for this company, and they're good for 3 years when they file a shelf. And this will allow them to raise up to $100 million of stock right here. So they could sell up to $100 million of stock. Now, since this stock is currently trading at $5 a share, gosh, to raise $100 million, they'd have to sell like 20 million shares. Given that the current float is 23 million, to sell 20 million shares would dilute all of the existing shareholders, by double. It doubles the float. And so the problem with printing more shares is it decreases the value of every current share that's out there. And this is a problem. Now, this is sort of a business of confidence where if people continue to be confident in the future of the company, as GameStop shareholders are, they'll continue to buy the stock even though the company is actively selling to you. With a lot of these smaller companies, the market is not quite as favorable to continue to just sell shares. At a certain point, people stop buying. And if the stock goes below $1 a share, remember, they'll no longer be in compliance with NASDAQ or NYSE, the New York Stock Exchange, which would force the company to do a reverse stock split. Now, companies, and this is one of them that did a recent reverse stock split. You could see right on the chart that S means they did a recent reverse stock split. And let's see if they've done any others. It doesn't look like they have, but there are other companies. It's hard to think of one right off the top of my head, but there's other companies out there that have done, look at the number of stock splits this one's done. Stock split, stock split, stock split, stock split. they keep having to do these stock splits to remain in compliance. And it's allowed the stock to almost just perpetually drop. It can just go lower and lower and lower. In fact, if you pull back the chart and look at the all-time highs, every time the stock goes below $1, they do a stock split, which pushes the stock above $1. And then it drops back down to $1. And then they do a stock split, and then it goes back to $1. And then they do it again and again and again. It almost seems like a cheat code to be able to just perpetually allow your stock to keep dropping. And in a sense, it is. It's a little bit of an unfair mechanism in the market. This is a particularly notorious stock. It's almost unthinkable when you look at, as we scroll up here, it's showing that the price was $1 billion. And that's because every time they do a split, it sort of moves the chart backwards, right? So the way this works is if the stock started at 10 and then it goes down to 10 cents and they do a 20-to-1 stock split, it goes up to $2. But then they've got to multiply this by 20. So then they're like 10 times 20 is 200. So to keep the chart consistent, it still looks like that. It just, the starting point goes higher by that multiple. So it's 200. Then they do another, let's say they'd have to do a 100-to-1 split. So then it goes up to 20,000, right? Now it's up at 20,000. And then they do another one and now it's 400,000. It's so on and so forth. And it just makes, so the price just keeps going, looks like it goes higher and higher. And what it essentially does is it makes it so the stocks can just continue to go lower and lower. Now, regulators don't love this and they might change that at some point. But in the interim, we have the stock here, ONCO. And so as I sat down this morning and took my first trades on it, I wasn't worried about whether or not it had a shelf. What I knew in the first moments was that this stock met all 5 criteria of stock selection. It had a catalyst, which was the 13D filing, and it was moving higher. So I was like, this is a stock that I'm interested in. There's some opportunity in this. And over the course of the next 5-10 minutes, I have a high degree of conviction that this is going to go higher. But once we got a little further into the open or into the trading day, I started asking myself, is this going to go to $7, $8, $9, $10 a share? And that's when I said, well, I got to take a look at the filings. And then once I see their cash position and their profit loss statement, that's where I start to get a little bit concerned. And then I see this right here, which came out just a couple days ago, notice of delisting. A notice of delisting and a failure to maintain compliance with the stock exchange, which was why they had to do the reverse split. So, unfortunately, this is going to be true with a lot of these small cap companies. But what's also true is that we can have these companies that have been beaten up for a long time, as this one was. This was a stock that's been beaten up for a long time. It's done a couple of reverse splits, as you can see here, here, and here. And then it goes in one day from $3 to nearly $24 a share. A small account trader loves a move like that. This was absolutely phenomenal. So look at this on a 5-minute chart. And we're going to get into technical analysis in a moment. But we see something like this, and it doesn't get much better than that. Basically, this stock started moving higher, and it just kept going higher and higher and higher and higher. From 5 to 6, 7 to 8 to 9 to 10 to 15 to 20 to 23. I mean, it's just unbelievable. There was another one, I think it was the next day, PRTG. They made an equally impressive move. We'll back this one up. And usually I find that in trading, when it rains, it pours, in both the good sense and the bad sense. When one stock is hot, we'll see dozens of others that are hot as well. But when things get cold, it can get sort of cold across the board. So this one went from 4 to 20 and then pulls back to 10 and goes all the way back up to $24 a share. Just unbelievable momentum. I mean, we just love to see stuff like that. But now long term, PRTG, it's another biotech company, right? So the price is now, after that big move, it's been pulling back. And I was wondering, are we going to see news that the company has been selling shares? And we may see that. We may not in that particular case, but it's certainly possible that we will. So as an active day trader, you could get away with doing zero fundamental analysis, if I'm going to be honest. You really could. Even if you just said, oh, there's news today, there's a fresh catalyst, and you didn't even read the catalyst, you would probably be fine. But I think you'll definitely be better off if you can understand some of the basics of fundamental analysis and understand how this relationship of supply demand works and why some of these companies are so inclined to sell shares onto the open market, because as they sell these shares through these offerings, it can just create a tremendous amount of selling. And we certainly saw that with GameStop. So it's good to be able to understand it. So now if we jump back over to our slide deck here, we've talked now about fundamental analysis, and I want to get into technical analysis. Understanding stock selection was a really big one. And now that you guys know that, I think you're in a really good spot, because stock selection is what I would call your first level of risk management. I mean, well, your first level is to train the simulator. And then the second thing is to choose the strongest stocks each day. As long as you're choosing strong stocks, you're going to be doing a lot better than the majority of traders out there who are trading the wrong stocks. Understanding fundamental analysis, important, but to a lesser extent. And now technical analysis is very important. So we're going to spend some time going over technical analysis, and that's going to take us right into entry indicators and exit indicators. So when it comes to technical analysis, what active traders use are candlestick charts, and that's what you've been seeing right here. These are candlestick charts, which the candlestick chart itself was created in Japan, actually hundreds of years ago. It was created for tracking the price changes of rice futures. And when you look at these charts, for beginner traders, it could be a little bit confusing, but the way it works is that each one of these charts, and there's 4 of them here, represent different periods of time. This is a 10-second chart here, a 1-minute chart here, a 5-minute chart here, and a daily chart here. And so each one of the candles represents the amount of time for that chart. So if this is a 10-second chart, you can see I could choose any different duration of time. Then every candle here is for 10 seconds of time. So every 10 seconds, a new candle will open. Now, this isn't a stock that's moving a whole lot right now, but if we looked at Apple or the S&P 500 or something like that, where it's actively moving, you'll see that these candles are constantly opening and closing. So each one of these candlestick shapes represents 10 seconds of time on the 10-second chart. On the 1-minute chart, each candlestick represents 1 minute of time. On the 5-minute chart, each candlestick represents 5 minutes of time. And on the daily chart, each candle represents 1 day of time. The anatomy of a candlestick, and this is going to be now technical analysis, is a candlestick has 4 pieces of information: the open, the close, the high, and the low. So open, close, high, and low. We always connect the body of the open and the close, and we draw a line to the top and the bottom of the high and the low. And so that creates a candle. Now, in this case, this would actually be a green candle where the price moved up. And we know that because we color it green, and the open is at the bottom and the close is at the top. In the case of a red candle, the open is at the top. The close is at the bottom right here. Oops, make that level right there. And then the high and the low are the same. So we call the center the body of a candle. So we've got the body, and then these are the candle wicks right up here. So those are the wicks. Just like a real candle, you've got an upper candle wick, and then this candle has a lower candle wick. It's a candle that burns at both ends, as it turns out. So this is the open, that's the close, that's the low, and that's the high. Now, this is the basis of the language of the financial markets. And what I'll tell you is that what I'm going to teach are the building blocks of reading this language, just like learning to read the English language or any language for that matter. First, we're going to start with the alphabet. So there are several key alphabet letters, so to speak, in the language of learning how to read candlesticks. And so if we talk about these individual candlestick shapes that make up the alphabet, I'm going to draw them for you and you're going to learn what they mean. So this is our first letter, so to speak. This is called a long body candle. It's a big green candle right here. And this is a candle that communicates a message. The open is at the bottom, the close is at the top. It didn't make a high, it closed at the high and it opened at the low. This is a very strong plus, very bullish candle. Bullish means strong to the buy side. Then we have the exact opposite, which is a red candle where it opened at the top and went all the way down. This is a very negative candle, the most negative candle you could possibly get, and this is a long body candle. Then we have sort of small body candles like this, which are less decisive, right? This is showing some weakness, this is showing some strength, but clearly the sentiment is much stronger on a large candle. Now, the next candle that I want to show you is called a candle of indecision. It looks like that. Now, it could be red or it could be green because the open and the close are usually more or less at the same price. But this is indecisive because the price moves up, it moves down, and then it closes the same place it opened. This is another variation of that same candle. It's called a spinning top. This one was called a doji, by the way. A doji and a spinning top. They're both showing a degree of indecisiveness. This is called a long-legged doji. It's the same as a doji, except the upper and lower candle wicks are larger. This is called a gravestone doji. This is called a dragonfly doji. And this candle here is called a hanging man. Do a couple more. Go to this side. So we did the hanging man. This candle here is called a shooting star. So let me give you some context for some of these candles. So let's say the price is moving higher. Long body candle, long body candle. What does this communicate? Strong sentiment, right? People are very bullish. Small body candle, small body candle. What's happening? The trend is getting exhausted. Doji, there's indecision. Long body red candle, there's selling. Small body red candle, indecision. Doji, indecision. Candle moving back up. Now the trend is reversing. Long body candle, long body candle. And then once again, trend gets exhausted, the candles get smaller, and a doji. So we often find that dojis are marking tops and bottoms as we have indecision in the trading. And while a doji communicates indecision, let's imagine that we substitute this candle. We take the doji out, and let's imagine instead we put in a shooting star like this. What would that communicate? That communicates a message even stronger than a doji. It shows that not only is there indecision, the reversal has already begun because the candle's gone red. The stock squeezed up and then dropped back down. When we see a stock that's in an uptrend and we see a large topping tail like this, these topping tails are bearish. They're weak. They show that while the price squeezed up, sellers pulled it back down. On the flip side, when we see a bottoming tail like this is actually strength because it shows that the price sold off, but buyers bought it back up. What if in fact instead there we substitute that candle out for a hanging man right down here? In this case, at the bottom of a trend, we would actually call this a hammer. We would say that this candle is hammering out the base. If we saw that same candle at the top of an uptrend, that's actually where we would call it a hanging man. It shows a little bit of weakness up here because that bearish, sort of that drop indicates some weakness. Now, yes, the price moved back up, but it's still not great to see that bottoming tail. We'd rather not see it at all. So a little bit of weakness up there, but down here, that communicates a little bit of a different message. So we're able to read sentiment based on the shape of the candle. And so what we end up having are multi-candlestick patterns where all of these candles begin telling a story. In this case, let's say right here, it's 7 a.m., boom, and all of a sudden out of nowhere, the stock was going sideways and then boom, spikes up 10%. So the second it spikes up 10%, we're gonna see it hitting our scanners, right? It's gonna be on our high of day momentum scanner as the stock is going up 10%, especially if this stock, of course, already meets our 5 criteria of stock selection. And again, if you guys haven't already downloaded the PDF resources, those are pinned in the top of the comments and linked in the description, so you can download all of those, and that's gonna put documentation behind everything that I'm sharing with you so far here today. So we first get that spike up, it hits the scanners, we're then pulling up the chart and we're saying, all right, this stock is moving higher. I like it. First, huge green candle, really bullish sentiment. Another big green candle. Wow, sentiment's so strong. Another green candle. Where should I buy? Can I buy it in here? Gosh, I can't. I can't buy it in here because it's too extended. It's just going higher and higher and higher. So it ends up topping out here, and then we finally get that reversal. Now let's say this reversal is just that small doji right here. It pulls back, we have a little bit of profit taking. People sell who maybe were in earlier. And then as it pulls back right here, this is the area where I get really excited. The reason is what I like to do is I like to buy the first pullback on a strong stock. When you have a stock that has breaking news, so this is a stock that's got breaking news that came out at 7 a.m. Let's say it's a biotech company. They've got clinical trials that were phenomenal, really good clinical trials. All right, so now the stock is squeezing up. That first pullback is gonna get bought up. That first pullback gets bought up because there's so many other traders that see this opportunity to buy a strong stock. But you don't want to just buy a strong stock at the very top. You've got to be able to manage risk. And so the way we manage risk is by waiting for that pullback. And as it pulls back, we see how low does it go. Now, let's say, for instance, this pulls back and it just keeps going lower. We just have more and more red candles. Comes all the way back down, right? Well, in that case, we don't take a trade. And it's easy to say that because, of course, I just drew that, but there's no entry indicator. So what is the entry indicator that we look for? Well, what I'm looking for, and I kind of think of this as a tide that's coming in. So we get a first wave up, and then it pulls back. And then the next wave is going to push even higher, and then it's going to pull back. And then the next one's going to push even higher than that. And so I want to ride the momentum. Momentum trading means looking for a trend and jumping on that trend as early as possible. So in this case, what I'm going to look for is the first indicator that this trend, which has been going up but pulling back, is going to reverse for the next leg higher. So how would I know it's going to reverse? Well, I could look at some of these candles that I'm familiar with, and I could ask which of these indicate there's some buying. Of course, any candle with a bottoming tail would indicate that although there was selling, the buyers came back in, right? And the second thing is, if we have a pattern of 4 or 5 green candles in a row and then 3 or 4 red candles, the first candle that simply closes green is probably significant. The only problem with that is if you wait for that candle to close green, what if it goes like this? Shoot, now you're getting in way back up here. That's too high. So what I actually like to do is I look at each of these candles as they're coming down. I wait to see if there's one that has a little bottoming tail, perhaps like this. And then the next candle, after that bottoming tail, as soon as this next candle makes a new high, right there, all it has to do is actually make a new high, which is breaking the high of that candle. So let's say the high of that candle is $7.30. When this hits $7.30, and then I see orders in green going through on the level 2, I'm buying right there at $7.30, and boom, I'm looking for that squeeze all the way back to the highs. So now my max loss on this trade is the difference between my entry and the low of this pullback right here. So let's say the low of this pullback is $7.10. So now I'm risking 20 cents, all right? So how much should I stand to profit on this trade in order to justify the risk? I would say I'd like to be able to double whatever I'm risking. So I'd like my profit potential to be 40 cents. Now there are times where you'll see a chart like this and you'll look at it and you'll think, well, you know, this is only, let's say 7.35. I know it doesn't make sense based on the scale of the chart, but let's just say it's only 5 cents a profit. I can't justify the risk. And then you don't take the trade. But if you look at this and up here is, you know, $8 or something like that, then you've got 70 cents. And that's a trade I'm definitely going to take every single day. Now, remember, just because I see that awesome pattern doesn't mean I'm going to take the trade. The stock has to meet my 5 criteria of stock selection. If it doesn't matter how good the pattern is, I cannot take the trade. The pattern is important, but the quality of the stock is number one. A quality stock. Now, if we have an A quality stock, then we of course would prefer to trade an A quality pattern. And this is pretty much an A quality pattern. There are some variations that could occur here that would make it a less than A quality pattern. So let me show you a couple of indicators that I use. Actually, before we do that, I'm going to jump back up onto the slide deck here, and I'm actually going to pull up, I'm going to give you guys a little preview. So those of you who have been interested in learning a little bit more about my strategy, I'm actually going to give you a little preview straight from the Warrior Pro curriculum. So in my full-length classes, I taught the first version of this class in 2014 was when I first taught this class. And when I first built this slide deck, it had 15 chapters, and I think the slide deck was like I don't know, it was like 15 slides long. There was like one slide for each chapter. It now is 1,700 plus slides long. And this is it's actually broken up into several slide decks. But what I want to show you here is this one section that I think you're going to really enjoy. So this is part of chapter 8, momentum trading strategies, and it's the long setup one in part buying the first and second pullback. So this is that same pattern that I was just showing you here, where we get the stock that squeezes up right here. Usually it's on breaking news. We get that first move higher, pullback, first candle dips, and then that first candle that makes a new high after that pullback is the entry. So I'm going to jump through these here just for right now. This is what that pattern looks like on an actual chart. Stock squeezes up, then you get that pullback. Oops. So squeezes up right here. Then you get in this case, 2 candles of pullback, green candle, first candle makes a new high. That's your entry right there at 424. Max loss is 418. So you're risking 6 cents a share on this, 6 cents. Per share, and profit targets to move back to the high, which in this case went all the way back up towards 450. So about 25 cents of profit versus 6 cents of risk. That's a 4-to-1 profit to loss ratio. So I'm going to animate this so you can see what it looks like. The stock is squeezing up. In this moment, as it's squeezing up, it's hitting our high day momentum scanner, but we're not going to just chase it. We're not going to just buy it up here. We're going to wait for that pullback. Finally, a red candle, it's softening, it's pulling back. We've got that topping tail. That shows us that it's a little bit bearish. Sellers are pushing it down. We have another candle that goes a little bit lower right here. Another candle here that's green. Now, a more aggressive trader may buy as soon as this candle closes in the green. A more conservative trader who's a beginner is going to wait to see what the next candle does. As soon as that candle, the following one, breaks the high of this candle, that's where I'm a buyer. So I'd be getting in right about at this line, and my max loss is low of this pullback, and my profit target is high of day. And you know what's kind of remarkable is that this is a setup that I've been trading for more than a decade. I mean, I trade it like every single day, and you'd think would it just stop working at a certain point? But the fact is, this pattern represents the psychology of what so many traders are thinking. Wow, this stock has really strong news. What happens immediately? The stock starts squeezing up as people buy it. And then you have a little bit of profit taking as people are like, well, I got to sell. I got to take a little profit. And then you have this next round of traders like myself who jump in to buy the first pullback on a stock that is strong, that has news. The biggest challenge beginner traders have with trading this strategy is being able to differentiate, is this the type of stock that has the potential to go up 20, 30% and continue higher, or is it just going to stall out? And that requires you to really understand those 5 criteria of stock selection and some of the bonus criteria that give the stock the potential to do something absolutely exceptional, like go up 500, 600, or 700% in one day. So now I want to show you a live trade. I'm going to show a clip here of an actual live trading archive of me trading this exact pattern. So when I pull up this live trading archive, you're going to notice a couple of things. Number one, you're going to see my actual trading software, which I haven't yet introduced to you, but I'm going to walk you through it right now. And you're also going to see how I am executing the trade and exactly the entry indicator and the exit indicator. So just in brief here, if we pull up our slide deck, in this section right here, we're transitioning from just technical analysis a little bit into our entry indicators and our exit indicators. And I also want to share with you some of the technical indicators that I'm using as well. But we're going to start, we'll start here with just this recording. Okay, so now let's watch this, this little live trading archive. So we currently have a stock, just to get us oriented, I'll just press pause for a second. We currently have a stock that is up 85% on the day. You can see that this says 85% right here. And I can see the stock right down here says 90%. This is on our scanners. So the stock is on the scanners. It's actually our second leading percentage gainer in the entire market. So as typical, I'm usually making my money on one of the top 5 percentage gainers. This one is interesting because the float is about 326,000 shares. That is a very, very low float. It's already got over 1 million shares of volume. It has a catalyst and it's moving higher. So we found the stock on our scanners, And I've already taken a few trades on it, but this is one particularly interesting trade. So the stock had its first move up, its first pullback right here. Now its second leg up, and it's on its second pullback right here. I like buying the first pullback, and I like buying the second pullback. And usually after the second pullback, I start to get a little more cautious because I don't want to chase it too much higher. So I like the first and I like the second pullback. All right, so I just got in here at 551. And the reason that I bought on this was because this stock is the #1 leading percentage gainer and meets all my criteria for having potential. Plus it has bonus criteria of a somewhat recent reverse split, as we can see right here, and a ridiculously low float of 326,000 shares, which means the supply is very low. This is a stock that's already exhibiting high demand. In fact, the relative volume is over 1,600 times higher than normal. So this is a stock that very closely meets like a quality setup. So I'm being more aggressive. So as it dipped down here, we had that little bottoming tail and it immediately bounced back up on that green candle. This is on the 10-second chart. Now a 10-second chart, every minute has 6 10-second candles. So by the time this candle goes green, I most likely already have an early indicator to buy on the 10-second time frame. So I'm using this fast time frame right here to give me that sort of early jump at what's moving. Now, those of you guys who are familiar, when we built out this software, we added the 10-second chart because I thought it was important for helping active traders spot these reversal indicators a little bit earlier. So bottoming tail and the candle going green. And then what I see is that burst of green on the time and sales. This time and sales window right here is actually showing a report of every individual transaction that goes through the market on this particular stock. And this right here is the market for this stock. The buyers are on the left, they're sitting on the bid, and the sellers are on the right, sitting on the ask. On the bid, we can see the number of shares someone wants to buy, and you always add 2 zeros. So if it says 1, that really means 100. If it says 8, that really means 800. And we see that there's a spread of currently 9 cents between 750 and 760. So let's go ahead and press play. So we're dipping down to 743 on the bid, 750 on the ask. So I'm currently red on this trade for a moment. I'm watching for that first candle to make a new high. 44 on the bid, 54 on the bid, 50, 60 on the ask. A little burst of green there. You see those orders that went through in green. That's what we like to see. That tells us other traders are bullish on this. 69 on the ask, 67 on the ask. And as an active trader, what my eye is primarily focused on is right here at the current price. So on that trade, I got in and I got back out, basically break even. I felt like maybe I was a little early. So when I got in, I was expecting immediately we would go back to the high, which was about $8. So the fact that we didn't go up immediately, I said, you know what, I better just get out. And that's one of the things that's nice about trading is you can get in and then you can jump right back out. So I got in and I got back out. Now the stock is coming back down here to this same level of support, right around 734. I make the chart a little bit bigger so I can read it better. And what I'm looking for here is still that first candle to make a new high. So now I've actually added back at the same exact price. But here's what's really fascinating. Look at how fast this has gone all the way back to $8. So if you look at this trade, this is in just an instant, it went all the way back to 8. I think the problem on this trade for me was that on my first trade, I tried to anticipate what was going to happen by getting in a little early. And I had the right idea, but I was a little early. This didn't work until that first candle made a new high. But look what happens. The second that candle made the new high, which is, so the high of that previous candle looks like is about 773. So 772 right now. And then watch, immediately it goes to 85. And then immediately it's at 88. And the next thing you know, we're coming up to 90, 99, $8. Now we're breaking 8 and I'm in with full position right here, 2,500 shares. I'm up over 50 cents a share. That's a solid move on an $8 stock. It's now up 104% on the day. We're coming up to 827. Now I'm up 75 cents a share. That is nearly 10% this is a 1-minute candle. This stock is going up 10% in 1 minute. That is an incredible move. That's exactly what we like to see. And I'm going to tell you, if you do that even just once a day, if this is the only setup you trade and you only take this pullback setup, you only see one trade a day that's A quality, once you are well trained to trade this on the right type of stocks, you should be able to maintain good accuracy. The question really is whether or not you'll have the discipline to follow the rules and to be patient. Because what if there's a day where you don't have that A quality setup? Or what if there's a day where you have some patterns on charts, but you don't have that A quality stock that meets all 5 criteria of stock selection? The right answer is it's a no trade day. But the beginner trader will typically trade anyways and go red, thus hurting their accuracy, their profit loss ratio, and naturally their self-confidence. And that can create this downward spiral. So one of the things that I have all of our beginner traders do, or I encourage them all to do at least, is to do the 1 trade per day challenge for a full month. And I'm of course doing this right now as part of my small account challenge. So each day I'm like, okay, guys, this is my 1 trade of the day for the small account. And then the rest of the day I trade in my regular account. But during that 1 trade a day challenge, the goal is to see if you can maintain 60% accuracy at a minimum, right? 60%, 70% is target. You're going to have losses, but can you be as accurate as possible? Can you be 60, 75%, 70% or higher accuracy? Because if you can, then you're going to do well. That's what's really important. So anyways, this stock ends up going up here to 37, 38, and then naturally it's probably going to be ready for another pullback. Look, it just went up 10% in 1 candle. So then this is where maybe it pushes a little bit higher, and then we'd say, okay, we're going to wait for the next pullback. In this case, if this held over $8, I might consider adding back because that's a really nice move and it's clearly showing it has the potential to squeeze up 10%. Maybe it could go a little higher, but I really prefer to trade the first and the second pullbacks. So now I'm going to back out of this chart for a second, or this screen, and I want to walk you through a couple of different indicators that I'm looking at. Then I'm going to also go back and explain those exit indicators that that prompted me to sell that position. So on all of my charts, you'll notice that they really are fairly simple. I'm going to zoom into the 1-minute chart here. I've seen people with charts that are very busy. They've got a lot of things going on. It's really hard to read. And you can add a lot of technical indicators, but technical indicators, they are helpful, but if you add too many, they're going to be counterproductive. It's actually going to be a problem because you're going to get analysis paralysis. So fewer in a lot of cases is better. And so I'm going to share with you the indicators that I'm using in my trading every single day. So my top technical indicators. All right, number 1 is moving averages. So a moving average takes the average price. So let's say we have a stock and we're going to add a moving average, and we're going to take over the last 9 candles, we're going to take the average price of the stock. So if this stock has been squeezing up over the last 9 candles, then we add all 9 candles together, we divide them by 9, the period that we're analyzing, and that is going to be our average over that period. So what I'm using is the 9 exponential moving average, the 20 EMA, and the 200 EMA. These are the 3 moving averages that I'm using on all charts: the 9, the 20, and the 200. These are very well-respected indicators that most traders use, and these help us understand potential areas of support. I have found that on the 5-minute and on the daily chart, these are especially valid, but on the 1-minute, they're valid as well. So look at this, for instance. This is an example where the stock came right up to that moving average right there and then fades back down. So the 9 is in gray, the 20 is in blue, and the 200 is in purple. So those are my 3 moving averages that are on all of my charts. When the price is above it, the moving averages form as support. When the price is below it, the moving averages form as resistance. So I primarily trade when a stock is above these moving averages, at least on the intraday chart, on the 1-minute and the 5-minute. The second is the volume weighted average price, which is the acronym is VWAP. So the volume weighted average price is very similar to a moving average. It factors in the average price over the course of the day, but it also factors in the amount of volume that takes place at each of those prices. And so the volume weighted average price is this orange technical indicator that I have on my charts right here. And this is actually telling us the true equilibrium point of this stock over the course of the day. This is its average price. So if it's below, then it's below average. If it's above, it's above average. And what we have found is that most stocks, when they're below the VWAP, they struggle to get back up above it. It's resistance. So if they can get back above and they can hold above it, then the VWAP becomes support for a move higher. So it's very common that when a stock is trading around the VWAP, we pay close attention. A dip off the VWAP can be a nice buying opportunity, but if it breaks the VWAP and it can't get above it, then that's resistance, usually for the rest of the day. So in this case, we have those three, the three moving averages, the 9, the 20, the 200, and then the volume weighted average price. So those are plotted as the technical indicator lines on my charts. Now, the next indicator that I use, number 3, are volume bars. So volume bars just simply communicate the amount of volume that takes place during each one of these candlestick periods. And I have my volume bars on a separate pane down here. Some people will overlay it. I don't like to overlay it because I find that it doesn't look good to do that. I want to be able to see the amount of volume visually on each candle. And so one of the things that's important is that when a stock is moving up, we like to see that it has high volume on the buying candles. So high volume buying, and then we'd rather see light volume selling. This is perfect right here. Light volume selling on these candles, and then boom, first candle makes a new high, and look at that surge up. And I traded this right here this morning. Again, like I said, this is the same exact setup that I've been trading for forever. We get that squeeze up, we get the pullback, first candle makes a new high, boom, there we go. That's the move. And this goes from 540 all the way up to 634. That's a fantastic trade. So volume is very important. And what we like to be able to see is that the profile of the volume is showing that there's more buyers than there are sellers. Now, I'm going to show you a couple of examples here. This is that really clean setup where we've got 2, 4, 5 green candles, 2 red candles, lighter volume on the second red candle, and then buying comes back in and it surges higher. I'm going to take that setup every day, all day long when I see it. Here's another one. This one's a little different because the stock was sort of going sideways and then it starts to pull away. After it pulls away quickly, we get that first pullback, then it surges higher. Light volume pullback, surging higher. We love that. Here's another one right here. So squeezing up and then light volume pullback, surging higher. Light volume pullback, surging higher. And the volume picks up big time on that one. Now this one, I want you to tell me what you think of. So here you've got 2 green candles and then it pulls back. Where's the entry? Well, we never had a first candle that made a new high. It just sold off more and more and more. No one really wanted to buy it. Why? The selling volume was substantially higher than the buying volume. It popped up on very light volume and then immediately high volume selling. So that's no good. And even though this stock has news, it still doesn't work. Now, I'll tell you that the float on this stock is 34 million shares. So in that case, that's a possible reason that failed. But there'll be other times where we see a stock that's got the right float. This one's 1.45 million shares, but it just doesn't work. Light volume on the buying candles, heavy selling as soon as it pops up. So in that case, once again, there is no entry. The entry is that first candle to make a new high. So even if you weren't using level 2, which is what we've got right here, this is the depth of the market that's showing all of the quotes and is showing the orders going through the market in real time. Even if you weren't using this, if you were just relying on the first candle to make a new high, that would be fine as long as you're trading the right quality setups. Now, I think using level 2 is important. It's like, it's going to give you more data, and that data is going to make you a faster trader and probably a more accurate trader. But first and foremost is the chart. Well, first is the stock selection, but then is chart. So if you don't have the right pattern, there's no trade there. When I try to get fancy and I try to anticipate by getting in early, I feel like a lot of those trades I end up missing on. There are some that work and I'm like, oh, nice, good early entry, but it's riskier. It's just better if I wait for that first candle to actually make a new high. So we get that pullback, first candle makes a new high. So I know the high of that previous candle. The way I know it is because when I'm pulling up my charts, I can actually mouse over right here. And this area right up here is showing me the open, the close, the high, and the low. So open, high, low, close. So as I'm mousing over candles, I'm looking at what it's saying up there. Sorry, I'll just make that full screen again. So I'm looking at what it's saying up there. See how those numbers are changing as I move candles? So on the 1 minute chart, we were looking at that. We get the high of this candle. So I'm saying, oh, the high of this candle right here is 541. right? So I look right up there at that price, and I put my candle over here, and I say, oh, that high is 541. So boom, now I know as soon as this candle breaks over 541, I'm a buyer. As soon as I see that first candle making a new high, I'm in. Now, if I pull up the level 2 and I see at 540 a bunch of buying going through, then I can already see other traders are jumping in this early because they like the setup. And then that's where I'm going to say, all right, I'm going to jump in this too. Getting in 1 penny early is not really a big deal, but getting in 15, 20 cents early could be a little riskier. You might get a false confirmation. So volume is very important. Now, the next indicator that I'm using is right down here, and this indicator is called the MACD. The MACD is an acronym, just like VWAP. This is an acronym that stands for MACD, Moving Average Convergence Divergence Indicator. So this is actually measuring these moving averages right here and telling us the rate that they're separating because the price is moving quickly. So the way these moving averages work is if you have a stock that is moving up really quickly, let's say you have a stock that's moving up really quickly here, your average price for the last 9 candles here, let's say this is 9 and this is 20, your average price for the last 9 candles is going to be higher. That's a higher average price than an average that includes all 20 candles back here, right? So let's say the average here, let's say this is a stock that went from 10 to 20. So let's say your 9 EMA is going to be maybe at around 17 because it's factoring in the price just from the last 9 candles. Whereas your 20 EMA might be more like 15, right? It's pulling back all the way to here. And your 200 EMA, well, geez, if this started at $5 a share, your 200 EMA might be down around $7. That might be even lower. And so what we notice is that as a stock is moving up quickly, the difference between the 9 and the 20, the price, it starts to move apart. And as they diverge, this indicator separates. So as your 9 EMA is pulling away, it's moving away from the average of this indicator. And what I have found is that consistently my best trades are on the first leg of a move up before these moving averages converge. Once they start coming back together here, we go into a period of sideways consolidation, and that's usually where it gets choppy. So I like to do as much of my trading as I can on the front side of the move when the MACD is open before it crosses over. And it's easy as a beginner trader to get a little overwhelmed and think, wow, there's a lot of things to follow along with here. And that's one of the reasons I would say that it's so important to have a mentor and to trade with someone where you can be listening to them in real time while they're trading. So every single day while I'm trading, I'm streaming at Warrior Trading and I'm providing my commentary. So I'm saying, okay, guys, I like this setup. These are the reasons why. Or someone's saying, hey, Ross, I like it right here. Do you think I should buy? And I'll say, well, the way I look at this is I look at this and I'm seeing reasons not to buy. I see the MACD is crossed over. I'm seeing the volume is declining. It looks choppy to me. So of course you should do as you'd like if it fits within your strategy. But if you're asking me if it fits within my strategy right now, the answer is no. MACD is negative on the trade. This is not set up. So I try to be very clear about when I like a stock, when it meets my criteria, and when, it's too risky, I gotta say no. Of course, you do as you'd like, but if you're trying to learn my strategy, it makes a whole lot of sense to be able to listen to me every single day while I'm trading so you can be practicing trading in a simulated environment and you can be practicing getting in, getting out. Does this make sense? Am I understanding the entries? Am I starting to kind of really internalize all the things I have to check? Okay, I've checked the 5 criteria for stock selection. I've done my brief due diligence to check the news catalyst. I didn't have to worry about doing any more fundamental analysis because it's the first leg of the move and we've got news. Now, technical analysis. What's the volume profile? How's the MACD? What's the position of the moving averages? So it's helpful to have that kind of, and even for me, it's really helpful to be part of a community because I have so many of our members who will throw me ideas and say, hey, Ross, take a look at this. And I might have missed something. So it's helpful to have more eyes on the market. And there's just going to be more when you're trading as part of a community of other traders than when you're trading all by yourself. So let's see. So then that was the last indicator, the moving average convergence divergence indicator that I'm using in my trading. So the last one is MACD. So moving averages, VWAP, volume bars, and MACD. Now there are some traders who use RSI. I mean, there's literally dozens, in fact, there's hundreds and hundreds of indicators and thousands, probably infinite combination of indicators you could use. But I'm a big advocate of keeping it simple. Don't overcomplicate it. Keep it simple. That's really the best thing you can do. One of the things that I think is important is recognizing that technical analysis is a universal language of the financial market. Every other trader out there who has some degree of experience is learning how to read these charts in basically the same way. So they learn the language. And what ends up happening is that inside these charts, there are dozens of buy signals and sell signals. You may not see them yet because your eye has not been trained. Just like I would look at, ancient hieroglyphics and not know what they mean. But these candlestick shapes, they have meaning behind them. And once you learn to read the meaning, that is empowering. And that becomes profitability. So if we pull back up this live trading archive just for a second, one of the things that I wanted to highlight are my, not just my entry indicators, but my exit indicators. So if my entry indicator is the first candle making a new high after a pullback, that's reasonable enough. So then where's my exit indicator? So this is the way I think about it. If I take a trade, I know how much I'm risking when I get in, and I can control how much I'm going to risk because I will sell if it goes down to the price where I'm saying that's my max loss. So I'll sell, I'll bail out, and I do that by manually pressing the buy and the sell button. I don't have any additional order confirmations. I can click buy, I can click sell. And one of the things that I can also do is I can actually harness my keyboard to set up hotkeys where pressing shift 1 or shift 2 instantly is getting me in and out of the market. I can show you how that works in just a second. But first, when I'm looking for an exit indicator, the way I think about it is if I get into a trade and, well, what do I want to see? Let me throw it to you as a question. What do we want to see when we get into a trade? We want to see the stock goes up immediately, right? That's what we would love to see. We get in and boom, it immediately goes up. That means we had the perfect timing. We had the exact right idea, the right timing. Probably all the other traders out there were seeing the same thing. So we're really dialed in on this stock. That's good. So then the inverse is what we don't want to see is we don't want to get in a stock and see it immediately drop, right? So this is sometimes helpful to sort of reverse it. So this is going to be the negative of what we don't want to see. This is the positive of what we do want to see. So if we get in a trade, we want to see price goes up, and I would say within 60 seconds. I'm a day trader, so I want to see it go up quickly. And a bad thing would be if price immediately drops, like just goes down instantly. I also wouldn't want to see big sellers on the level 2. So when I pull up the level 2, I can see the size of the sell orders. So right now I see a 200 share sell order, and then there's a 2,000 share sell order at 760. Those aren't big sell orders. But if I saw a 50,000 share sell order, that would be pretty big. That would be concerning. So right now when I'm getting in, I don't see any big sell orders. But I do take profit right there. And I took profit right there, not because I saw a big sell order, but simply because I had achieved my first profit target, which is it broke through the high of day and squeezed through the whole $1.08. Something that's really interesting. So we want to see no big sellers on the level 2. We don't want to see, I'll say red on the tape, red candle. So we don't want to be in while a candle goes red. So we want to see here green candles, right? Green on the tape, which is the time in sales, and no big sellers, but we'd be okay with big buyers. Big buyers are a plus, so that's okay. All right, so that's kind of what we're thinking when we first get in. And then one of the things that we know is that most stocks actually trade with quite a good deal of respect for half dollars and whole dollars. And this is kind of interesting. The way this works is when a stock first starts moving up, a lot of people will put out profit targets at just kind of like a logical area. Someone will say, oh, I'm in the stock at $2. You know what? I'll just throw a profit target order at $2.50. or someone say, I'll just put a profit target order out at 3. So the stock starts at $2. This is $2.50. This is 3. This is $3.50. This is 4. And what you would notice is that most of these stocks, as the price moves up, there's going to be a whole cluster of sell orders right around 250, and another cluster of orders around 3, another cluster of orders around 350, and another cluster of orders around 4, right around these half dollars and whole dollars. This is just, they're psychological areas of resistance. It's just where people logically put an order. So as the price first starts moving up here, big green candle, breaking news, big green candle, and then we hit resistance. Resistance at 250, the half dollar. And this is usually where we see our first pullback. Now, if you remember in that live trading example, that archive, we were trading at the half dollar of 750. So we hit 750, we pulled back. So in this case, we hit 250, we pull back, and then we break through. And if we break through, we squeeze up to the next level like this. So now we're up to 3. We pull back here for a moment, we dip down, and then we pop back up. But what sometimes happens is we pop through, and then immediately we dip back down. And now what's happening is we're testing to see whether or not there's enough buyers to prove that we can hold 3. If there's more sellers, we'll drop back down below 3. But if we test and we hold, then we base out for another move higher. So sometimes a stock is super strong and it just blows right through, but very common that we break and we pull back. So if I get in this for this break right down here at 275 in this example, it goes up to 310. I'm going to take some off the table because I know it's probably going to come back and test 3. So I'm going to capture as much profit as I can on that first cross through the half dollar and the whole dollar, especially if that means I'm booking profit and I'm hitting my profit target on the trade. And that's exactly what happened on this trade right here. So on this trade here, it ends up breaking through, it ends up going very nicely up to 775, up to 788, up to 790, breaking through 8. As it taps 8, notice here, there's a little bit of resistance there. There's a couple more sellers at 8 than there were at any of the other prices. A little bit of resistance, so a little bit of moment of truth. Is it going to break 8? And then it immediately goes and it's like, all right, take that profit off the table. We're breaking 8. Because what we know is that it's very possible that we'll come back down to 8. So now we're back to 813. 815 on the bid, 804, we're back to 8. So now we're retesting 8. And I already took some profit at like 825, 826, 823. So I took that extra 23 cents of profit. We dip back down. Do we hold 8? Now, right now it's holding, but then it goes all the way to 89 by 90. So this is a really good example where now it's below the whole dollar. Now it's back above it. So it's struggling a little bit there. We call that straddling, a half dollar, a whole dollar. And now it's got to it's going to now have to do another pullback. And that's fine, but I might as well just take my profit, get out, and then I can always get back in. So when it comes to exit indicators, when I get in, if the price is just squeezing higher, if I don't see any obvious exit indicator, I'm going to hold as long as I can. I don't want to sell if I don't have to. I mean, I'd rather stay in the position. But if it starts to kind of stall out, or it breaks through a level like the half dollar, whole dollar, then I'm going to say to myself, I better book some profit on this thing. It probably makes sense. Now, I have a couple other, kind of interesting live trading archives here. I'm not going to go through all of them. I do this when we're in our full length classes, but I think for right now, let's jump on to the next section. So let's see. And again, we're trying to condense 27 years of trading knowledge here into this comprehensive but relatively concise class. So we've gone through this first section here and we've covered entry indicators and exit indicators. Let's talk now a little bit about risk management. So we know without a doubt that trading is risky. I mean, I think it goes without saying. It is a high risk activity. And there are some people that don't have the appetite for risk and just get too paralyzed by the thought of losing money that they can't even trade. I think that for a lot of traders, I'm actually very risk averse. I don't like taking risk. And what's kind of funny about that is I'm an active trader. But for me, I find that it's a lot easier to predict what a stock is going to do over the next 5 minutes or 10 minutes than over the next 5 or 10 days. And so the way I manage my risk is by holding stocks for short periods of time. I get in on a pullback, the first candle to make a new high, and then I take profit as soon as we get that little dip. And so by being very precise about getting in and getting out, I feel like I'm reducing my risk. But active trading is risky. And it's risky for the primary reason that most beginner traders jump into the market without a proven strategy, and they're trading with real money as they get started. So the number one biggest step you can take to mitigate your risk is trade in a simulated environment instead of putting real money on the line. So at Warrior Trading, for our members, we offer a trading simulator that actually is very similar to the platform that I'm using every single day with real money. And so it allows you to trade the market, real-time data, side by side with me as you'd like, without putting real money at risk, which I think is important. But if you use Thinkorswim or maybe a different trading platform, some of those brokers do offer simulators that you could use there as well. So step one for mitigating risk is to trade in a simulator. What is step two? I think you already know, so this is a little bit of a pop quiz. So risk management. So number one is sim, and number two is stock selection. By choosing the strongest stocks each day, you are greatly reducing your risk. Number three is avoid over trading, which is why I always put beginner traders on the 1 trade per day challenge. Now, it's worth noting that as a beginner, when you first get started, you don't want to just take 1 trade a day. You want to get as much experience as you can. Right? You really want to. You want to trade everything because it's an opportunity to get better at reading charts, to get better at reading the language of technical analysis, to get better at reading level 2, the time in sales. So you want to trade a lot. But then you get to the point where you say, all right, I've been trading in the simulator for a while and I'm actually making some money. I'm thinking about going live. How do I transition? And the way to transition is to start in the simulator with the 1 day per day challenge. So you try to just do 10 days in the sim, 1 trade a day, and test yourself to see over these 10 days, am I, number one, net profitable? And number two, what's my accuracy? And number three, what's my profit to loss ratio? So those are the 3 core components that we look at. So avoid over trading and doing the 1 trade per day challenge. And then analyzing profit loss ratio, which is all your average losers compared to all your average winners, your accuracy right here, so profit loss ratio, accuracy, and net profit. If all 3 of these are well, if your net profit is positive, that's the most important. And then as long as your accuracy is above 60% and your profit loss ratio is better than 1-to-1, then I would say at that point, you could advance to trading with real money, but only trade with super small size for the next 10 days. And repeat this 1 trade per day challenge with real money, but with like either 10 shares or 100 shares, whatever is an amount of money that if you lose, you feel nothing. You don't even care. So if that means taking $20 of risk on every trade, take $20 of risk, right? If it's $2 of risk, start with $2 of risk. Whatever your comfort zone is, you just want to start at a level that you can totally 100% handle, and honestly, cut it in half. Just don't overestimate it. Cut it in half, and that way you are 100% trading at a level that is like negligible. You do not care. And that's important because that means you could focus on trading the setups really based on the quality of the setup. Now, when we talk about risk, we also have to think about the total amount of money in a position. So when I take a trade, if I buy 1,000 shares of a stock at $3, I'm putting $3,000 into that position. Now, some people would say, Ross, you're risking $3,000. And I wouldn't say I'm risking $3,000 because I own something that I can resell on the open market. So I bought it at $3. If I don't like it anymore, I can sell it. The question is, what can I sell it for? And being able to understand the realistic difference between your entry and the price that you could sell it for means having some experience reading the market. You might think I got in at $3, I can sell it at $2.99. I'll only lose a penny. When in reality, if it drops quickly, you might sell at $2.85, and that was the fastest you could get out, which means instead of risking 1 penny, you're losing 15 pennies. 15 cents, that's $150 on 1,000 shares. It's not the end of the world, but that would be a bigger loss. So in order to be able to calculate how much you're really risking, you've got to look at the difference between your entry to the difference between the low of the pullback for the setup that you were trading. So if you're trading the first candle to make a new high, and then you look at that and you say, all right, well, in this particular example here, that had me with an entry at about 750 and a max loss at about, I think it was 730. So we were risking about 20 cents per share on that trade. All right, that's my realistic max loss. So if I put $1,000 in that trade, I'm not risking $7,500. I'm risking 300 bucks, 200 bucks, and that's it. It's kind of like flipping a house in a way. If you buy a house for 200 grand and you plan to put some money into it and sell it for 250, you're not really risking 200 grand. You own a house. You know, obviously houses are not as liquid as stocks. Stocks you can get in and out of in the same minute. A house is going to take some time. So the stocks are even a better example of the fact that you can just get out the second you don't like it. So I think of my account and the money in my account in a way as a tool. And I use that to be able to buy and sell stocks. And although I might buy $5,000 worth of stock, I'm really only risking a couple $100 on any one of those trades because I'm never going to hold until something goes to zero. That's not realistic. Why would I ever do that? So I'm going to get in, I'm going to have my max loss, and I'm going to sell if it hits that point. And it's as simple as that. So that's the way I think about risk. The best way to mitigate risk is to trade in the simulator, to use stock selection, to avoid overtrading, to focus on a 1 trade per day challenge, and then to remind yourself that the amount you're risking is the difference between your entry price and your max loss. That's the reality that we're in. So for me, I mitigate my risk, I think, quite well. I've taken an account with less than $583.15 to be exactly precise. And as I grew it to over $13 million in gross profit, the biggest drawdown that I ever had during the entire challenge was about 3% of my account. So when we look back at my account right now and we look just at the last 90 days, let's see, we'll look at recent 90 days. There are some drawdowns here, but these aren't substantial drawdowns. My account, I mean, I'm never drawing down more than a couple $1,000s, really. Even if I draw down $30,000 off of a total profit of 13 million, these are not substantial drawdowns. These are very small. Now, I'm fortunate because I trade a strategy and I have chosen to keep my strategy within risk parameters that mitigate my downside. So although I'm sitting up almost $800,000 on the year, if we look at my year to date, the most I ever was at risk of going red on the year. Well, if we look at year to date, what we can actually do here is we can look at the overview and, we'll go to detailed for the year. And then we're going to go to win-loss expectation. And this shows the biggest drawdowns that I had of the year. So I started the year pretty much in the green, just focusing on each day coming in, trying to get 1 or 2 good trades. Some days I got 3 or 4, just chipping away, trade after trade after trade. And, then eventually I caught a little bit of a loss in March. I had my drawdown, went down 30 grand over the course of 2 days. Not great, but recovered very quickly and it counts back to the highs. And then again in June, a little bit of a drop. Those drops in June were what led to me looking at my my average losing days and noticing my accuracy was only 50%. I wasn't happy here. I said, this isn't good enough. I got to do better. And then went on to a 45-day green streak. Then a couple of losses, recovered, another loss, recovered, and the account kind of stays right near the high. Now there's other traders out there that might draw down a lot more, 6-figure drawdowns, 7-figure drawdowns, but when they rally back up, they have 6-figure, 7-figure kind of green days. I just don't trade at that level. While I think it's wonderful for the people that are able to trade at that level, I can't handle the emotional risk that comes with having those types of big red days. So I've chosen to scale back my own, I guess in a sense, upward potential based on the fact that I'm not comfortable with the downside risk. But here's the thing that I'll tell you. If you're not comfortable with downside risk, the upside that you could have, would have, should have made doesn't matter. Because if you can't handle the risk, it's not worth taking the trade. We're not here to gamble. We're here to make money consistently. And to make money consistently, we've got to be managing risk. Risk first. How much am I risking on this trade? And can I justify taking the position based on that amount of risk and what I think is a realistic profit target? And for this class, I've really focused just on this one setup of buying the first pullback. I call it the micro pullback setup, buying the first pullback, second pullback. And there'll be a link pinned at the top of the comments. It's the download of all of the PDFs, and it includes my micro pullback strategy PDF. Now, one thing that I'll note is I have this book over here. Let's see. It's this one here. It's not this one. It's Thinking in Bets by Annie Duke. In this book, she talks about how her brother taught her how to play poker. Annie Duke is a professional poker player who's made millions of dollars playing poker. And she said when her brother started teaching her, he said, these are the hands you should play. And he gave her a list of the different hands that she should play. And she said, well, wait a second. I see other people playing different hands. You know, they've got different cards, but they're still playing it. And they're better than me. So why shouldn't I play it? He said, listen, I'm telling you to play these hands because these are the ones that as a beginner have the highest degree of success. It doesn't mean there aren't other hands you can play. There are. You'll learn them later. Right now, your job is to keep your head above water. So these are the only hands you play. Just like that. And I want to encourage you to do the same. So this first pullback setup, my feeling is that this is one of the best strategies for a beginner to trade because what you're benefiting from is that wave of momentum that comes right after a stock has breaking news. You've got that breaking news, you've got that squeeze, and you're buying that first pullback. And this is a strategy and a setup I've been trading for so long, I'm really confident in it. So this is the setup that I'm trading whenever I'm doing small account challenges. It's like, that's the pattern, that's the setup, and I'm not going to make it overly complicated. So what I'm actually going to do for you guys is one of the links in that, in the PDF, one of the downloads in that group of PDFs is my trading plan. And it's a trading plan that documents exactly what to do as you're trading a simulator during those first 30 days, how to find the stocks, where to get in, where to get out, the metrics that you want to achieve. So it really sets it up almost as a business plan. Now, the next thing that I want to talk about is when to walk away each day. And this is actually a great book here, The Power of Knowing When to Walk Away. It's also by Annie Duke. And what I like about this book is she talks about how important it is to know when to step back because so many beginner traders, their biggest struggle is overtrading. So someone who chronically overtrades is going to be a trader who essentially is just, it's almost like, I feel like almost like sitting at a slot machine, just like pressing. It becomes compulsive. They're like unable to walk away. But the fact is, while at a certain point in your career, having greater quantity of trades can mean more profitability. As a beginner getting started, one trade a day can be more than enough. One trade a day, that's it. You don't have to overcomplicate it. You get one trade and you pull 20 cents a share out of the market. Okay, with 100 shares, you're only making 20 bucks. But you start with $20 a day. And if you could do that consistently for 10 days, for 20 days, for 30 days, for 40 days, then you start increasing size to 200 shares, to 400 shares, to 500, to 600. Within a couple of months, you're trading 1,000 shares. You're doing $200 a day consistently. Boom, that's $50,000 a year. That's a foundation. That's the starting point. And you could do that all the way up to trading 5,000, 6,000 shares and doing $500 to $700 to $1,000 a day with one trade a day. Now you get to a point where you realize, all right, I'm holding myself back by not taking 2 trades or 3 trades on a day when the market's hot. The problem is, for a lot of traders, it becomes a slippery slope. When you're doing just one trade a day, it's easy to say, one trade a day, that's it. But once you're doing 2, you're like, what's the difference between 2 and 3? What's the difference between 3 and 4? What's the difference between 4 and 400? And next thing you know, you've really broken the ice. And now you're just trading with almost no restraint. So one of the things that I talked about in my book, How to Day Trade, is guardrails. You will not win the Tour de France with training wheels on your bike. But as a beginner, you need those training wheels to keep you safe, to help you have a positive experience. So when you're getting started, you can build confidence. So you can put yourself on that positive feedback loop. So as a beginner, I think it's really important to have these guardrails, even though they can feel restrictive. And you know that you're not going to keep them on forever. For right now, they keep you safe. And so one of those restrictions is limiting the number of trades you take every single day. And the easiest way to do it is to trade in a cash account. Because if you're trading in a cash account, once you run out of cash, boom, you're done. So you could fund a cash account with $3,000. You could trade one $3 stock with 1,000 shares each day. You get in at $2.90, you sell at $3.10, that's 20 cents, 200 bucks. Boom, your account's green, you're done. Your cash is now tied up. You got to wait till the next day to trade again. And I think that that really is a good way to approach it. So for me, knowing when to walk away, as part of the beginner's trading plan, we just sort of basically, we automate it and say it's after you've taken one trade, because that's the rule. You trade in a cash account, you've taken one trade, then you're done. Once you've proven profitability over the course of several months of trading one trade a day in a cash account and you've increased your size, only then do you say, all right, I think I'm ready to graduate to taking 2 trades a day. And you can still do it in a cash account. You just take trades that are a little bit smaller amount of money. So now you take 2 trades. Now you take the next day, 2 trades, 2 trades, 2 trades. You do that for 10 days. You prove that you can trade a little bit more. You take 3 trades. And on some days you only take 1 because there's only 1 good setup. But on other days you take 3, then you take 4, then you take 5. And you know what's going to happen? You're going to get to a point where you're going to expand a little too fast and you're going to have a loss. And this is one of the most important things that can happen to you. You have your first big loss and then you prove you can recover. And how do you recover? By putting the guardrails back on. By going back to 1 trade a day for a week, just until you've smoothed back out. It's so important after having a big loss that you stop the bleeding as quickly as possible. So it's like, I imagine being in a rowboat and a big loss is like all of a sudden I hit a rock and there's a giant hole in the boat. So the first thing I have to do is stop the bleeding. I've got to stop the water from coming in. So I've got to plug this hole. That's the first thing. Stop the water from coming in, right? Stop the bleeding, stop losing. The next step is to start bailing yourself out. But there's no sense bailing yourself out when you're still digging the hole deeper, when you're still making mistakes, you're still spiraling, you're still emotionally compromised. First, stop the bleeding. So add the restraints, add the guardrails, slow down. 1 trade a day. Stop the bleeding. Now start slowly bailing yourself out. 1 trade, 1 trade, 1 trade. Slow recovery. And then you get to the point where you're like, okay, I'm back. I'm feeling good, right? And now I'm calm, cool, collected. It's amazing how quickly traders can go from calm, cool, collected to fully emotionally hijacked. And then it takes a couple of days of calm trading, 1 trade a day, to bring it back down. It's so easy to reactivate and go right back to that emotional place. So for most beginner traders, the cash account is the way to go. Now, the next thing you could do for knowing when to walk away each day is to set a max loss. This is the most I'm willing to lose on any day, and it's X amount. If I'm down below that, I'm done. Now, with the broker that I'm using, I can actually call them and I can say, hey guys, put a max loss on my account. If I'm ever down more than $5,000, lock my account and don't let me trade for the rest of the day. And they're happy to do it. They're happy to do it because they don't want to see me lose money. I've been a client for a long time. They want to see me continue trading for a long time. So they don't mind putting that restraint on my account. In the event that I have a day where I go down more than $5,000, boom, account is locked. So you can't do that with all brokers, but with some brokers, you can do that. So if you've got a broker that allows you to do that, then you absolutely should. It's like a safety net. It's like having it's like rock climbing without the, being on belay. Why would you take that risk? Just put the risk parameter on your account. It's done. You do it once. You don't have to think about it. But on the one day you need it, it's there for you. So that means our kind of exit indicators here for not on a particular trade, but on a particular day is when to walk. So, and we'll just say quit. When to quit each day. So 1, certainly max loss, right? Max loss, dollar amount, boom. Number 2, 3 red trades. And I would say if they're back to back and they're sizable, just 3 red trades, period. You might have 3 red trades and you're down like $12. So it's not really about just 3 red trades, but if you have 3 big losses, I follow the 3 strikes you're out rule. Number 3, if I give back half my profit. So if I end up having a day where, I went from up, from 0 on the day to up 1,000 and then I give back half, I try to walk away there and remind myself that, you know what, the glass is half full. I'm incredibly fortunate. And, even a day like today, I'm up $3,700. My daily goal is 5,000, but I'm going to say, you know what? I got to be grateful. This is a really solid green day. And there's a lot of people that work a lot more hours than I had to work today to make a lot less money. So be grateful for what you've got. I find that when traders fall into that habit of revenge trading and becoming emotionally hijacked, you're angry and frustrated because things aren't going the way you wanted them to go. All right, you didn't want to have a red day. And the fact is, I feel like in those moments, we're no longer grateful for what we have. Because when we start over trading and giving back more and more losses, we're losing what we have, chasing what we wish we had. So if we can just accept that, you know what, the glass is half full, life is good. It's a small red day. Hey, big picture is I'm still green on the week. Big picture, I'm still green on the month. I'm still green on the year. Why let one day get me so bent out of shape? Does it really matter? And that is part of being a good loser, being able to recognize the big picture, that one red day is not significant. In fact, there will only be two really significant days in my trading career: my biggest green day ever and my biggest red day ever. Those are 2 days in a lifetime of trading. Every other day is just in between. A little green, a little red, doesn't really matter. As long as I'm consistently making a little more than I'm losing, I'm doing well. As long as I'm consistently sucking just a little bit less, I'm doing well. Now, in order to really understand how well you're performing, you do have to be able to analyze your metrics. So I want to talk about the review of metrics right now. I'm going to pull up the software that I use. And by the way, I'm not an affiliate of any kind for any broker or any platform. I use Day Trade Dash, which is my own software that I've built out. And I use TraderView, which is software that I've been using for a long time. And if you use them as well, that's fine. You're welcome to. If you don't, that's fine too. It really doesn't matter to me, but this is what I've been using. So the way this works is you can import your trades. So when I import my trades, I use Lightspeed as my broker. I tag my account with IRA because it's an independent retirement account. And then I click here and I upload my file. And I click on that and then I click open. Now I already uploaded that file for today, so I don't need to upload it a second time. Or I can't actually. It would duplicate the trades and kick them out. So you upload your trades and you can import from any one of these brokers. We've got the Warrior Trading Simulator here. So we've got our simulator you can import from, but you can really import from any different broker. And just like that, you import your trades. You choose your broker, then you look at the instructions of how to do it. You import your trades. So once you import your trades, what I'm looking at when I'm importing my trades are a couple of different key components. I think that there are 3 core components to profitability. So I call them the profit trifecta. It starts with accuracy, profit loss ratio, and then consistency right here. These are the 3 core components. So we're going to start by looking at my accuracy. All right, so my accuracy here, and we'll just look at last month, for instance. We'll look at a smaller period of time. Doesn't really matter, but last month was pretty nice, so we'll just take a look at it. All right, so detailed. Last month, I traded better than average, maintained 70% accuracy. All right, so accuracy right here, 70%, solid. Now my average winners and average losers. All of my average winners, my average winning trade was $516, and my average loser here, $283. So that gives me a profit loss ratio of about 2-to-1, which is good. So profit loss ratio 2-to-1. And then the consistency over the month, how many weeks were green? And so for the month of August, all 4 weeks were green. I was green each month or each week here. Well, I guess it's a short week, but nonetheless, green, 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 green. So very solid month. Now, a month like that, is there really anything to correct? Is there anything I coulda, woulda, shoulda done differently? Realistically, on a really solid month like that, probably not. If we look at the last 30 days, what you'll notice is that in the last 30 days, my accuracy declined a little bit, my profit loss ratio declined, and my total profit declined as well. And what you'll notice is that there are a couple of things the data is going to tell me. Number one, I had some losses trading higher price stocks. That's a mistake. So I took a little bit of risk and traded some higher price stocks. I did not get paid for it. I had another mistake during this 30-day period. I traded later in the day. So during this cycle, I was teaching live classes from 12 p.m. till about 2 p.m. every day. And so because I was teaching those live classes, at the end at 2 p.m. after I finished trading, I would often be looking at the market because I'd been teaching class all afternoon, and I'd say, oh, look at this. And then I took a number of trades going into the close, and those cost me quite a bit. Now, this is sort of atypical of me. I don't usually trade in the afternoon, but in fact, that cost me a lot in terms of accuracy. It hurt my accuracy. It hurt my profit loss ratio, and it hurt my consistency. And so after seeing all of that, I made the realization that I needed to make a change. And it was easy to see that by looking at my metrics. I saw right in my metrics, it was plain as day. I said, Ross, if you have stopped trading right here at 11 a.m. every day, you would have been better off. So do that now moving forward. Now, it's true that during the month of August, I did have some nice trades in the afternoon during power hour. And maybe it was that particular month, It worked. But in September, I tried implementing essentially the same strategy after I finished teaching classes. And for whatever reason in September, it didn't work. And that might just be that there's not a lot of rhyme or reason to it. It just, for whatever reason, this month was not as clean with setups into the close. But I think the problem for me that I noticed was that when I took a loss at 3 p.m. after having previously had a good day. So right now I'm sitting at $3,740 and it's 418. So 418 in the afternoon. So if right now I take a trade on this stock and I lose $3,000, it's like I lost something that I've already had for 6 hours, 7 hours. And then I just lose it. And like, there's a much bigger sense of loss, and that can create the bigger sense of loss, the bigger emotions, which then leads to an inclination to revenge trade, to try to recoup those losses as quickly as possible and start to spiral. And that's what happened to me on several days, where all of a sudden in the close, I made a couple of mistakes. So I'm a big advocate of having you guys review your metrics so you can track your performance, and so you can give yourself, kind of that honest feedback of what am I doing right now that's working? What's working and what's not working? Because, invariably, on a month where you struggle, you'll find some element that's like, ooh, okay, I should do that differently. Actually, I have another month here I'll show you. So we go back to March. So March of this year was a little bit of a tough month for me. And this is all relatively speaking, because these are green months, but nonetheless, look at this. So on this month, I was really venturing in the higher price stock range. And in fact, it wasn't even necessarily just higher priced, but I just wasn't performing well on stocks above $10 a share. So I said, you know what, man? This is not working. All right. So what are you going to do for the month of April? You're going to keep trading stocks between 1 and 10, or between 10 and 20? How about for the month of April, you only trade stocks between 2 and 10. So let's look at the month of April. Month of April, I do $45,000 of profit. I basically traded nothing above 10. I got a couple of trades and that was it. So I stayed much more disciplined. And the result was better profit. So it takes an ability to look at your metrics to see this. And one of the things I've noticed about a lot of traders that really disappoints me is I've seen a lot of beginner traders that do not track their metrics at all. So they're not looking at their performance. They literally have no idea. So they'll say, oh, I'm not trading well, I'm losing money. And I'll say, well, what's your accuracy? Oh, I don't know. What's your profit loss ratio? Oh, I don't know. And that to me is like someone complaining they don't feel well, but never going to the doctor. It's like, don't complain to me if you're not going to put in the basic, the basic work to try to figure out what's going on. So I often ask my members to say, hey, students, so go ahead and send me screenshots of you doing the 1 trade per day challenge and show me how it looks. So this is a student, Jack, who did 1 trade a day, really solid, very disciplined. This is a trader who a little more intermittent, did a couple trades on different days. This is a trader who stuck with it pretty well, 1 trade a day. Another one trade a day. And look, there's going to be some red days in there. And even if they're bigger losses, as long as you're mostly green, I think you're going to be pretty happy. And that's really been my approach. And it goes back to what Jess was saying of just, getting in, getting out, not overstaying your welcome. Get green and don't push your luck. Be grateful for what you've got. So once you know how to review your metrics, what you do is you take those metrics and you take the trading plan that I've already given you and you document that into an actual business plan. So here's the idea. If you're thinking about investing $5,000, $10,000, $25,000 into your trading business, I think you should write a business plan. I think you should prove to me why that's a good investment. Why that $25,000 is better with you trading it than putting that money just into the S&P 500 or even putting it into treasuries. You get a nice treasury with a nice interest rate, you put it away, you're guaranteed to earn interest. So are you going to outperform that treasury? Now, setting the bar relatively low, you should be able to if you've practiced in the simulator, if you've proven you've got the metrics, but this is that next step. And the traders who do better are the ones who really approach this as a business. Approaching it as a business also helps sort of compartmentalizing the losses. You have a loss, it's like, well, that's a business expense. Look, every business has a business expense. And for me, it's once a week I have a loss. That's okay. As long as I follow the rules, it's a successful red day that is part of what is overall a very successful strategy. So it's not a problem. So by documenting your business plan, you're outlining the time of day you trade, the price stocks you trade, where you get in, where you get out, how you find those stocks, how you manage your risk, how you're going to account for your gains and losses, what you're going to do for taxes. I mean, there's several different layers of it. When you download the group of PDFs, you'll get my trading plan in there, and you can use that as a starting point for developing your business plan. Now, the business plan, I wouldn't say you need the business plan before you start trading a simulator, but I do think it's helpful to have at least a trading plan before you start trading a simulator so you can make the best use of your time, especially because most trading simulators cost a little bit of money because you have to pay for real-time market data and the exchanges make you pay for it. So starting in the simulator, definitely an important step. And again, use whatever simulator you want. We have one at Warrior Trading, which I think is great. But if you want to use one with Webull or with Thinkorswim or whatever, that's fine too. If you want to trade one trade a day in a commission-free account, one share a day for trades, you could do that, and it's kind of like sim trading because it's only one share, but you just want to make sure you keep your positions super, super moderate. As I said, transitioning to real money, you only do that once you've met the metrics for success. You then do the 10-day challenge in the simulator. You then transition to do that same 10-day challenge with real money. And if you can't, if it doesn't work with real money, then you obviously go back to the sim until you're able to prove that you can maintain those metrics. You sort of keep going back to the sim, get to the point where you can maintain the metrics, improve your accuracy, and then try the 10-day challenge again. So some people go live and then they go back to the sim, and then they go live and then they go back to the sim. Once you're set with live and you're starting to do well, that's when we move into scaling up your business. And the way we scale it up is by increasing the number of shares you're trading first and the quantity of trades you're taking second. If you go to increase the quantity of trades first, you say, I'm going to go from trading 1 trade a day to trading 10 trades a day, but you're doing it with small size, it's going to be a problem for a couple of reasons. Number one, in a cash account, you're going to run out of buying power. And number two, it's going to expose you to the trigger of having a loss, getting really desperate, getting really frustrated, and then struggling to recoup and revenge trading. So it's better to build the discipline and to build the consistency at the rate of 1 trade per day and first increase share size, because you can make money with 1 trade a day with 2,000, 3,000 shares. That can be more than enough. So I think that's the better way to approach it. Try to capture 10 to 15 cents, 20 cents per share of profit out of the market each day. Once you're doing that consistently, max out your share size with that 1 trade a day. Then introduce 2 trades a day, 3 trades a day, 4 trades a day. That's the right way to approach it. And then that's also the point where you say, all right, now I'm going to consider transitioning from trading in a cash account to trading in a margin account. Now, we have to talk about taxes and retirement planning. One of the things that I think is absolutely incredible about day trading is that you can day trade in a retirement account. And I've done exactly that. I set up a Roth IRA. I did a traditional IRA, then converted it to a Roth. And I set it up, and then it was with $18,000. So the way the Roth IRAs work is you've got your max contribution. So for me, contribution, I funded $6,000, and I did this, I think it was in 2019, 2020, and 2021. So it totaled $18,000. It might have been 2018 that I did the first one. I can't remember. But in any case, I funded it with $18,000. And from there, I started day trading it. Now, until I was over 25,000, I only took 1 trade per day. 1 trade per day. And really, it was only a couple of trades per week. It wasn't every day I was trading it. Once I was over 25,000, from there, I just kept growing the account. I've actually grown that account from $18,000 in initial contributions to over $7 million of profit. $7 million, fully audited profit. Now, my results are not typical, but that is real money. And the wonderful thing about trading is that you can trade as much as you want in a retirement account. And in a Roth IRA, the income is tax-free, and the distributions, when you take them, are also tax-free. The only problem is you can't touch the money until you're 59 and a half years old. And so what a lot of beginner traders will do is they'll trade in a regular account to produce profit in order to pay bills and things like that. And I think that's wonderful. And then what I encourage you to do is, as soon as you possibly can, start saving money into a Roth IRA and plan to use that Roth IRA. So you'll each day trade in your one account. You get your one trade a day in the first account, and then you get your one trade a day in the Roth IRA. One trade is tax-free, saving for retirement. The other trade is taxable. But that's okay. You want some taxable gain. That pays, your bills and everything else and generates some profit. So you want to do that, but then that second trade is in the Roth IRA. So then you get to the point where you're doing 2 trades a day, one in the main, one in the Roth IRA. And you slowly grow that Roth IRA. Now, the way I think about it is when I created my IRA with $18,000, I grew it pretty quickly up to 100 grand. And then I started thinking, well, how much money do I really need in an IRA? When I'm trading, and how much money do I really need in my day trading account? If I'm trading a stock at $10 a share and I want to buy 10,000 shares, that's $100,000. All right, so that's a pretty big position for a beginner trader, but for someone like me, I could handle doing that. I probably wouldn't go a whole lot heavier, maybe 15,000 shares. So realistically, $150,000 is about the most that I need in my trading account. So what do I do when I take 18,000 and turn it into 7 million? Well, I keep about 150,000 in my trading account, and then I do a direct rollover to an IRA, which is long-term. So this is a long-term IRA, and with this money, which is now about 6.9 million over there, 7 million just about, that I invest long-term. And for that, the goal, 8% a year. I'm not trying to be crazy. I'm not trying to be a hero. I want slow, consistent returns. But look, 8% a year on a nearly $7 million account, this is hundreds of thousands of dollars per year, completely passive. I don't even have to think about it. And now this can grow for the next 20 years. I can't touch it for 20 years anyways. So this gets to just keep growing and growing and growing. And every time I get my account up to 250,000 to 300,000, I take another 100 grand out, I send it over here. I take another 100 grand out, I send it over here. And so this account stays perpetually relatively small. Again, $150,000 is not a tiny account by any means, but I keep it relatively small, and then all excess profits go over to the long term. And one of the other things that's really nice about this is by never keeping much more than $150,000 in this account, I also am risking the most that I could ever really lose day trading. So having turned, $583 into 13 million in gross profit, there are some traders who trade a strategy where in one trade, they could lose $5 million. And that's not possible for me because I don't have enough money in my account for that to happen. So it's very important for me that I pay myself and I clear the profit off the table and I put it away. I put it away. I put it away. That's an additional form of risk management. I only keep enough money in my account that I realistically need to execute the trades I'm going to take on a daily basis. Now, some people would say, Ross, you turned $583 into 10 million. Why didn't you start with 5,000? You could have turned it into 100 million. Why don't you start with 50,000? You could turn it into $1 billion. And here's the problem. During my $583 to $10 million stretch, my average position size was 8,000 shares. So if I wanted to 10 times that, I would have needed to have traded with an average position size of 80,000 shares. If I wanted to do 100 times that, I would have needed to trade with an average position size of 800,000 shares. And I'm telling you, that's not possible. So there is a limit to scalability in the market. I know people out there that do trade with 80 and 100,000 share positions on a fairly regular basis. And look, they have 6-figure red days. They have days they go red $200,000, $300,000, $400,000. They have days where they're green $300,000, $400,000. They're playing in a little bit of a different game than where I'm at. I don't have emotionally the ability to tolerate that type of loss. I just don't have it in me. So my own success to a certain extent is limited by my personal risk profile, just as yours will be. You may not get to the point where I'm at, or you may far exceed where I'm at. I have several of my students who have earned $1 million badges who are trading at a higher level than me, and I'm super proud of them. And I hope that they continue to do really well. But there's nothing wrong with that. I don't feel competitive with that because, look, we have different risk profiles. So that's okay. You just have to find what works for you. But what works for me is making sure I save for retirement. I'm putting that money away long term. And when it comes to taxes, the more that I can save, the better positioned I'll be in the retirement account, the better positioned I'll be because I keep my tax bill very low. Now, when it comes to taxes, what a lot of traders will do is they'll file for what's called mark-to-market accounting. When you file for mark-to-market accounting, you become completely exempt from wash sales. A wash sale occurs when you take a loss and then you buy back a substantially similar position within 30 days. When you do that, you're no longer allowed to write off the initial loss. And that could be a problem for a trader, for instance, who wants to trade the same stock every single day. Now, that's not my strategy. So if you're trading the same strategy as me, you don't really probably have to worry about that. But wash sales can still be a factor if you're trading the same stocks over several days and you do have gains and losses. So what most traders will do is they'll file for mark-to-market accounting, and that's exactly what I did. And as soon as you file for that, you notify your broker that you've changed your accounting status to mark-to-market. And from that point forward, you no longer have any wash sales that are exempt that you cannot write off against your income. Now, the next thing that I really encourage people to do is to treat trading as a business. So of course you have your business plan, but you also want to think of all of this as equipment. Trading is a business. If it's producing profit and this is something that you're doing, it is your business. So all of this equipment, you can expense it. You can depreciate it, deduct it. You've got the monitors, you've got your computer, you've got your subscriptions, you've got your education costs. You've got all the things that you put in to this business. If you were starting a coffee shop, you would treat all of this as a business expense. If you went to workshops to learn about how to run a coffee shop, if you took classes, if you took courses about how to run a coffee shop, those are expenses. You would itemize all those expenses and you would deduct them against your income, especially in those early years when you're doing the startup. There are many people who will be negative during their first year because they're trading in a simulator. They're not putting real money on the line, but they're incurring some cost through market data, equipment, subscriptions, education. And so you want to make sure you itemize all that and you keep that set aside. A good accountant will help you make sure you do it all the right way. I think a good accountant is worth their weight in gold. So I highly encourage you to get good accounting CPA advice to make sure you're making the right decisions. But these are things that I've done in my trading that really helped me a lot. And I think were definitely the right move, certainly when I was getting started. So I have officially condensed 27 years of trading knowledge into this class right here, which I think is the ultimate beginner's guide into how to start day trading. If you enjoyed it, I hope you hit that thumbs up. I hope you subscribe to the channel. If you didn't already download the collection of PDFs, make sure you guys check that out. And I will remind you, as always, that, hey, trading is risky. Our results aren't typical. So manage your risk, take it slow, and I'll see you here for the next upload real soon.